Okay, good morning, everybody. So my name is Professor Michael Gasharek. As I said yesterday, I'm a trade economist, so I'm obviously going to be talking to you about international trade. And thank you very much for inviting me to this conference. I have thoroughly enjoyed it so far. And in particular, I've enjoyed riding up and down these walk-on, walk-off lifts, which I've never experienced before. Great fun. Thank you. So what I want to talk to you about today is work that we've been doing on the trade effects for the UK of leaving the EU. And this is joint work done with my colleague Niccolò Tamberi, who is also in the room. So in summary, what we're doing in this paper is to think about those impacts of the UK leaving the EU on trade, and leaving aside the politics of that decision and the overall economics, from a trade perspective, this is something which trade economists describe as a sort of trade policy reversal. So it's increasing barriers to trade between countries, but in a way that has never really been done heretofore. So it's a major, if you like, policy change or policy shock. What we're doing is using a range of econometric techniques where we're exploring, is there any evidence of any impact of the referendum itself on trade between the UK and the EU? And separately, is there any evidence, or what is the evidence to suggest any impact on trade following the Trade and Cooperation Agreement, which came into force in January 2021 between the UK and the EU? So the free trade agreement, essentially, between the UK and the EU. The bottom line is that we find no evidence of a referendum effect on aggregate trade between the UK and the EU. There's no evidence to suggest that this impacted negatively or indeed positively, although that would be a bit bizarre, on trade. Conversely, we find that the TCA had strong negative effects on trade, but those effects differ substantially between exports and imports. Take exports first of all. Exports dropped dramatically in January 2021. So when the TCA kicked in, they dropped by 40%. Now, just to put this in a little bit of context, openness of the UK economy, so exports plus imports as a share of GDP, is around 65%. So the UK is a fairly open economy. Trade matters quite a lot to the UK. And roughly 50% of our trade is with the EU. Trading goods or trading goods and services, roughly 50% of what we do. So a decline in exports of 40%, that's a pretty big number. What happened, however, with exports is that they recovered. So over the course of the year, exports recovered, and there's no evidence over the course of the year as a whole of particularly of a negative impact on exports of the UK to the EU. That's not true when you think about imports. Imports declined dramatically in January and continued to be down throughout the year. So we've done this on over the year as a whole, but also we're doing this on a monthly basis. Imports from the EU are consistently down over that first year of the TCA by anything between about 24 and 27%. If you ask most economists, most trade economists, in December 2020, what they would have predicted to be the impact on trade as a result of leaving the EU, I don't think anybody predicted this asymmetric impact and this recovery in exports. It is interesting and important, I think. We explore one possible reason for this and find positive support for this, and I'll explain this more, excuse me, in my presentation, that it could be to do with what we're calling a relative market size effect. Okay, let me just kick off with a little bit of contextualizing. So what I've got here is exports by the UK and other OECD countries on the left, and imports on the right on a monthly basis over time relative to January 2012. So we're indexing this against the first period in our data set here, and we're just looking at total trade, exports and imports. And what this chart reveals is that more or less, and the black line here, the solid black line, by the way, is the UK in each chart, and the gray lines are the other countries. But the trajectory of trade over time, up until 2021, the UK's path is fairly similar to most other sort of OECD countries here. and this applies to both exports and imports. When you get to 2021, UK trade appears to significantly underperform or to underperform with regard to exports and imports. And that's kind of quite interesting and setting the scene. This does something similar, but we're now looking at the GDP volume index for the OECD countries, where the blue line is the OECD, the grey lines are individual countries, the red line is the UK. Now, while in our paper, we're not looking at GDP effects, this, as I say, this is sort of context setting. Again, we find a very similar trajectory of the UK to the OECD prior to 2020 and 2021, and then the latter half of the period, in particular in 2021, the UK underperforming the OECD economies on average. Recent work by John Springford suggests that UK GDP is approximately 5.1% lower now already than it would have been had we not left the EU. You may not be surprised to hear these sorts of numbers are not talked about very much in the UK press. Excuse me. Policy background. Should be pretty familiar to most people in this room, but it's worth going over this quickly. By leaving the EU, the UK, in inverted commas, left both the EU customs union and the single market. The reason the UK I put in inverted commas is because the UK is composed of Great Britain plus Northern Ireland, and arrangements for Northern Ireland were different. So Northern Ireland has remained within the single market for goods, not for services, and is still part of the EU's common customs territory. The TCA itself is a tariff-free, quota-free trade deal, tariff-free, quota-free free trade agreement. So there are no tariffs notionally on all goods, but that tariff-free trade is conditional on meeting rules of origin, on proving, so the UK can export to the EU duty-free if it can prove that the good was really produced in the UK and not produced elsewhere. And those rules of origin are actually very complex. They're detailed at the product level, and there's lots and lots of different rules of origin. I could talk about this for a long time, but I won't. But what is interesting about that, the interesting statistic about that is, over the course of 2021, roughly 25% of UK exports that went to the EU that could have entered duty-free paid a tariff. So exports for which there was a preferential margin, there was a positive EU MFN tariff, most favoured nation tariff, roughly 25% of those exports by the UK to the EU paid a tariff. We don't know what the converse figure is, EU to the UK, because the UK government isn't publishing that data. It has it, but it won't publish it. So in addition to tariffs, by leaving the single market, there's a range of other potential barriers or obstacles to trade between the UK and the EU, to do with regulatory barriers, to do with mutual recognition of conformative standards, and so on. So, as I said earlier, this is a sort of a major example of a trade policy reversal. In connection with those standards and regulations, here's a quick chart, as it were, just to, again, this is scene setting, as it were, and this derives from other work that we're doing at the UK Trade Policy Observatory, which is where we've taken all the EU single market regulations, identified which products those regulations apply to at the very detailed level, for those of you that know about trade data, the HS 6-digit levels, at the very, very detailed level. And then this chart aggregates this up into groupings. So each one of those columns is an industry, if you like. It might be textiles, it might be chemicals, and so on. And what this chart does, it just gives you a flavor of how many EU regulations apply to different products or product groups. So if I can get this to work. So this very high bar here is fishing. So there are 40 regulations that apply to fishing. Mechanical appliances and engineering is another one where lots of regulations apply. And down here, only one regulation applies to musical instruments. It just shows you the range. In fact, there are a lot of regulations that potentially apply, and that it ranges a lot from sector to sector. And these are all potential barriers to trade between the UK and the EU. They may not be actual barriers, I'm aware of that, but they are potential barriers. In terms of related literature, it's actually quite hard to find much by way of related literature relevant to what we are doing here, simply because this is such a big, I keep saying this, trade policy reversal. So there is a literature on countries leaving free trade agreements and what was the impact of that. But most of that leaving of free trade agreements actually turns out to be because you're leaving one free trade agreement, such as the Ukraine-Estonia free trade agreement, such that Estonia joins the EU. So it's a very different set of circumstances, or the former Eastern European countries leaving Comecon in order to join the EU and so on. So there's very little relevant literature on this. There's the literature on Trump tariffs, which is also a sort of form of trade policy reversal, but it's a very different sort of policy shock or policy change. It applies to a much smaller share of trade. It's largely focused on China. It's largely tariffs. It's not non-tariff barriers. So it really is very different. There's also a small literature, people like Crowley, Graziano, Handley, and Lemauer, who do some work on the impact of the Brexit referendum on uncertainty and firms entering into exporting to the EU, showing some evidence of negative effects and so on. But really, there is not much out there. There was a bunch of ex-ante studies, simulation studies, predicting what might be the impact of leaving the EU under various different scenarios, hard Brexit, soft Brexit, and so on, typically using either CG modeling or gravity modeling. Sorry. So what do? We take the monthly trade data and evaluate post-2021 and post the referendum, what was the impact, if any, on UK trade with the EU? We use three different methods: difference in difference, triple difference in difference, and synthetic control. We do this for exports and imports separately, and we're using monthly data. So immediately, the months after leaving, the month after the introduction of the TCA, sort of early 2021, there were reports in the press about the decline in UK trade with the EU. Now, obviously, we are interested in looking at what happened to UK to the EU. And you observe, hypothetically, well, you do observe that that trade declines, but clearly trade exports of the UK to the EU may have declined simply because of a supply shock in the UK, which meant that we were exporting less to everywhere, including the EU. So in order to identify whether there was a TCA effect, we need to compare what happened to UK trade to the EU with UK trade to a control group of countries, the non-EU countries. So the difference in difference analysis that we do compares UK trade with the EU, the treatment group, with UK trade with the rest of the world, which happens to be, in our case, the OECD plus the BRICS. We exclude Canada and Japan because in that period, the EU signed free trade agreements with Canada and Japan, and we don't want that to confound the analysis and so on. And then we're looking at whether there's any evidence that UK exports to the EU behave differently to UK exports to the non-EU, and we do this for both the referendum period and the trade and cooperation, introduction of the trade and cooperation period. So using that difference in difference methodology, we can control for shocks that occurred in the UK at any point in time, which might have impacted on UK exports in a common sense to both destinations, and that helps us to identify the TCA effect. But of course, there could be differential shocks in the control and treatment group countries that we're thinking of here. It could be hypothetically that COVID hit the EU much harder than the non-EU, and therefore there was lower demand in the EU for UK goods, which has got nothing to do with the TCA, but because COVID hit differentially in the EU as opposed to non-EU. So we control for that by a triple difference in difference technique, which now we also include trade flows between the EU trade with itself and with non-EU countries, again, with the OECD and BRICS countries. And that essentially allows us to control for all those differential effects. So we do this double difference in difference and triple difference in difference. Now, in all of that work, we are choosing the treatment group and the control group, if you like, mechanically, ourselves, manually. We are saying, okay, this is the control group, non-EU. Sorry, this is the, sorry, yeah, the treatment group is the EU, the control group is the non-EU, and so on, and we are choosing that ourselves. It might be that not all those countries are very good as controls. So then we also do the synthetic control method, which entails choosing only a subset of bilateral flows between countries as control units, and then aggregating those with a weighted average. And those weights are chosen to maximize the pre-treatment fit. So essentially what we're doing for the pre-treatment effect, if you like, the pre-TCA effect, if we're thinking about the impact of the TCA, we're choosing those flows that most closely matched UK trade flows prior to the treatment group, prior to the treatment, prior to the change in policy. And then we're saying after the change in policy, how did UK trade, observed UK trade evolve in comparison to those control group countries which the synthetic control method has selected? So those are the three methods that we use. 5 minutes, right. I did start a bit late. Trade data is complicated, mainly because of changes in collection method once the UK left the EU. Done a lot of work on this, thought about this very carefully. So we're using UK data for UK reported trade flows. We're using EU intrastat data for EU reported trade flows with other countries other than the UK. Okay, so there were changes in the way trade flows are recorded, which makes using the data quite complicated. Now consider these two charts. So the chart on the left gives UK exports to, in blue to the EU, to the UK to non-EU. And we've got the referendum period here. Again, this is monthly data. And for each month, what we're showing here is trade. So take January 2020, hypothetically. So the point for January 2020 here is showing you January 2020 relative to the average of the Januaries in 2012, 2013, 2014, 2015. So we're indexing relative to the same month in the pre-referendum period. But it essentially shows you the evolution of trade over time. This is UK exports to the EU. This is EU exports to the EU and non-EU. And what you see is around the referendum period, no evidence here graphically of a referendum effect. And similarly, when you're looking at EU trade flows to EU and non-EU. When you get to around the period of the TCA, the introduction of the TCA here, we see this dramatic decline in exports that took place, followed by a recovery, such that there's very little difference by the end of the year in exports, and EU trade behaved very differently. Exactly the same thing with regard to imports, but now the striking difference is, start again. Same thing with regard to imports. Again, no obvious referendum effect. When you look at the TCA effect, this is what I was discussing earlier. You see this fall in imports from the EU relative to the non-EU. This blue line is considerably below the orange line and stays considerably below. And that's essentially what we're going to be finding. This is the data that we're using in the econometrics, but this kind of tells the story. So, some quick results. This is the results for the referendum. Difference in difference, triple difference, exports on the left, 2 columns, imports on the right, 2 columns, no evidence of any effect. Synthetic control tells us exactly the same thing. No evidence. So here I'm now plotting the actual UK to EU with the synthetic control UK to EU in orange. And you can see that around the referendum, no evidence of any effect. Moving on to the effects of the TCA itself. So we're now talking post-January 2021. Again, I'm now showing you more formally what I said to you at the very beginning. No evidence with regard to exports that over the course of the year, exports were materially lower to the EU relative to the non-EU, but strong positive impact on imports. So this negative effect on imports. I shall skip that because I won't have time. And exactly the same things with the synthetic control method. So let me move on to say 2 more sets of things, then I will conclude. First thing is, although I am telling you that in aggregate, there was no impact on exports, that's not true that there was no impact on trade at all, on exports of any sort. So if you do this by disaggregated by section, So we're now disaggregating our total trade into 21 different categories. We see that there were some industries that were seriously negatively affected. Look at the figures there for footwear, for example. So exports of footwear to the EU are down 72% over the year. For that industry, that is a big shock. That is a big change. Textiles, 59% down. So while in aggregate exports recovered, that's not true by any means for all sectors. And there's other emerging work suggesting that small firms, small trade flows have been more impacted and have declined considerably in comparison to larger trade flows. Again, the results for imports are quite different because we get much more homogeneity of results. Out of those 21 sections, there's only 5 that show no negative impact on trade on average over the course of the year. All the others show a negative impact. So now leading on to a possible explanation for this differential export-import effect. One possible explanation here that we explore is relative market size. And essentially the idea is the following. The UK accounts for about 5%, 5 to 6% of EU exports. The EU accounts for nearly 50% of UK exports. So for UK firms, dismantling trade relations with the EU is potentially a much bigger issue than for EU firms dismantling trade with the UK. And if there are going to be increased barriers to trade with the UK, EU firms might simply just decide, okay, so we're not going to supply to the UK as much as we did before. Okay, so this relative market size effect potentially could play an important part. We do this by running our triple difference and difference regressions by country and by sector. So we're looking at the impact of every single bilateral flow between the UK and the EU for each EU country and the UK and for each HS section. And then in the second stage, we regress those coefficients on the relative importance of the market in each country's exports. And we find very strong confirmation of this hypothesis that relative market size appears to matter and matter quite a lot, matter significantly, both in terms of the actual magnitudes and in terms of statistical significance. So the relative market size effect appears quite important. Note that prior to Brexit, I'm just about to stop. Prior to Brexit, all those simulations, pretty much all the simulations that are out there, and there was quite a lot, gave you symmetric results for exports and imports. Depending on the type of experiment, it might be that exports were predicted to decline by 30% and imports by 28% or 32%. But more or less, the ballpark magnitudes were very, very comparable. What we're finding with this trade policy reversal is that that is not the case. The results are quite asymmetric, and I think there'll be a lot of work being done over the next few years trying to understand this better. So to summarize and conclude, the referendum had negligible effects on aggregate UK-EU trade. That's the referendum itself. TCA had strong effects, but these very, very asymmetric trade effects that I've discussed. And one possible reason for those asymmetric trade effects, which we explore, is this role of relative market size. Thank you very much.
Thanks a lot for giving me the opportunity to read and discuss the paper. I really enjoyed reading it, and I think it's an important paper. Let me try to summarize it in one slide, or maybe 2 slides. The subject is the trade effects of the UK leaving the EU. Thanks. And especially the authors look at 2 parts of this process. First, they look for effects of the referendum, and second, they look for effects of the TCA, which since the beginning of 2021 guides the trade relationship between the UK and the EU. As Michael explained, they use different methodologies, basically 3 methodologies to look at both of these 2 questions. And what they find is, first of all, no significant impacts of the referendum, but significant and interesting impacts of the TCA. So especially like across the methodologies, they find strong and significant effects on imports, but no, or small coefficient estimates, but no significant effects on the export side. They explore a little bit what's behind this asymmetric effect using a two-stage methodology, which shows that they find smaller declines for those markets that are supposedly more important. And they sort of conclude from this that this is at least suggestive evidence that what's behind this asymmetry is the fact that the EU is more important for the UK than vice versa. So to the best of my knowledge, this is the most up-to-date and most comprehensive analysis of the trade effects of Brexit. So I think it's going to be an important reference for people going forward. I also think that another contribution is that they provide some new results, especially regarding the impact of the referendum. I'll come back to that in the next slides. And also they find this super interesting effect about the asymmetric effect. And I'm also going to talk about this because sort of I'm guilty of trying to predict the effect of Brexit, and I predicted almost completely symmetric effects, and I'm going to talk about this a little bit. So I think this result about the asymmetry really makes us also think about our models that we use for quantification of trade cost changes. Yeah, so my discussion is going to center around 2 points. First, I would like to talk a little bit about the effects of uncertainty and anticipation that other people in this literature have found, which are sort of absent in the study, or maybe not absent, but not focused on in the study. And then I want to talk a little bit about this sort of missing impact on exports. Regarding the effects of the referendum, or sort of the effects that the authors find between the referendum and the TCA, I think the paper could make a stronger point by stressing that they find new results. So we have some results in the literature which show that sort of the uncertainty created through the referendum, the uncertainty about the future trade relationships, and also potentially anticipation of a worse deal than what we were coming from, have generated some impact, some measurable impacts, at least according to other studies. So just to mention the one by Fernandes and Winter, who look at Portuguese exports to the UK and find significant impacts of the referendum. So I think this point receives a bit more attention, especially sort of a more extensive discussion of the literature review. And there are also two studies, the last two I'm listing here, which use quite similar methods, so synthetic control methods, but I believe some variation of it and different data, and they do find effects. So I think it would be kind of worthwhile to try to analyze where the differences are coming from by either sort of applying the method from this paper on the data the others are using, or using their data with the method in the present paper. Then I also disagree a little bit regarding the conclusion that there were no effects after the referendum. So especially if you look at the right graph here, which shows sort of an event study of the differential impact on UK imports from the EU, to me, the graph very strongly suggests that something was already happening after the beginning of 2020, so 1 year before the implementation of the TCA effect. And so the authors say that this event study analysis is not as robust as the others because of, for example, it fails to account for seasonality, but given that this anticipation effect, as I interpret it, happened sort of throughout the whole of 2020, I think seasonality is actually not a concern here. So to me, this is not a problem. It's not a bug in the paper, but it's a feature. I think it's a very interesting result. And if it's there, I think the impact on imports that you estimate is actually a lower bound of the true effects, because it doesn't include this anticipation effect. And to look at this in a bit more detail, I think you could redo the synthetic control method as well, but change the period during which you are matching the treated and control. So currently, the treated and control are matched all the way until the end of 2020. But if you kind of stop making them equal at the end of 2019, then you could potentially also observe this anticipation effect in the synthetic control method. And I found some additional results in the appendix of the paper, which I think also suggests that there could be something there. So the authors also do a synthetic control method analysis where they match controls and treated pairs only until the referendum. And then so the graph shows you basically that after the referendum, there were small differences emerging between these two groups. And maybe not statistically significant. I guess that's where your conclusion comes from, but at least sort of from the visual inspection, to me, it looks like there were some effects actually also on the export side. And I think these results are super interesting, so they could be discussed more prominently in the paper. Then I'll come to this missing export effect, which I, as I said, found super interesting because it's really difficult to explain with the standard trade models that we're using sort of in 95% of all cases where we try to quantify the aggregate effects of trade cost changes. So these standard gravity models. And I thought a little bit like, how could we generate asymmetric effects in this CGE world? And some explanations I came up with could be the sectoral composition of exports that's different, and if sectors are hit heterogeneously, that could lead to different effects in the aggregate, or sectoral trade elasticities that differ could also be an explanation. A second potential reason is that the UK and the EU are located at different places in the global value chain, and we know that trade cost changes at the more upstream locations have magnification effects. And so that could also, in theory, generate asymmetric effects. So I went back to one of my own papers, which sort of has tried to quantify the impacts of leaving or of a dissolution of the single market. And there we do have some results on Brexit as well. So this is a CGE model featuring also a notion of global value chains and upstreamness and downstreamness. It has heterogeneous effects, heterogeneous sectors, and we also feed in heterogeneous cost effects that we estimated from single market entry rather than exit. So in the right part of this table, you see our prediction where I basically regressed our simulated trade changes on the same triple difference indicator, and you see the symmetry that comes out of this exercise. Compared to this striking asymmetry that the authors find in this data-driven paper. So I conclude from this that these explanations I have put up, they are apparently not sufficient to generate this asymmetry. Other potential explanations are, of course, a very trivial one could be asymmetric trade cost changes. So maybe the trade costs of UK exporters just didn't increase as much from the change to the TCA, but at least from the text of the agreement, we have no sort of reason to believe that this was going on. Then the other explanation that the authors also explore a bit more in the paper is the idea that market size matters. And from a theoretical point of view, I think we're then more in a world where we think about fixed cost, where it really makes a difference how big the market is, whether you want to pay these costs or not. And so the authors explore this argument in their paper with this two-stage analysis that Michael briefly presented, where they first kind of obtain coefficients for every UK trade partner pair and sector, and then regress this coefficient on a measure of market size. This share here, which when we look at the impact of UK exports, is the relative size of that destination market J in total UK exports. And if we look at UK imports, it's the size of the UK market relative to the European exporters' total exports. And well, as predicted or as hypothesized, they find that sort of market size matters here. There are a couple of things that concern me here. The first one is that these weights, so relative market size, is measured during the period after the referendum. And if we believe that there were at least some effects of the referendum or the uncertainty during the period before the TCA, or after the referendum and before the TCA, then these shares are already going to be affected. So an easy fix here, I think, would be to just use shares from the pre-referendum period. I also thought that an easier way to get at this question would actually be a quantile regression. So rather than this two-stage methodology, I think you could just estimate these coefficients here for different quantiles of the distribution of the outcome variable. What I was also wondering about is that when you look at the market size effects here, you take from, when we have a UK exporter, you take the size of the single European country that you are trading with. But I think the argument is more that the EU as a whole market, so the single market altogether is what makes sort of this trade, or what makes the exporter more willing to pay these costs. So I'm not sure if the market size of sort of one individual EU partner is the right measure here. Also, I think if you go down that road and put forward this argument that market size matters, I think it's also important to think about the import side, because the UK is the EU is the most important export market for the UK, but it's also the most important import market. So in a sense, you're assuming here that it's always the exporter who pays the cost. But if the EU is the most important sourcing country, then importers might also be willing to actually absorb this cost. So one nice placebo test, I think, would be to just run the same exercise with a measure of import market size. I'm going to skip these small comments and come to the conclusion. So the most important conclusion is that I think this is a really nice paper and has super important effects. Findings. I put forward my slightly different interpretation of the results on anticipation or effects before the TCA. And then regarding this issue of the missing export effects, my recommendation would be to either do a little bit more thorough analysis of this market size argument, or maybe to leave this part out and instead replace it with sort of a comprehensive discussion of the different mechanisms that in theory could be behind these findings. That's all I wanted to say. Thank you.
So thank you so much for the opportunity to comment on this very interesting paper. So if you have read the paper, you may see that this paper is actually very carefully done and is also very smoothly, beautifully written. So I'm going to start this discussion by summarizing what I really liked about this paper. So apparently this paper is very timely, is also on a very still evolving topic. So probably nobody in this room would disagree with my statement that UK is very much still in the middle of the turmoil caused by the referendum and the Brexit deal, etc. And this paper has very nice, interesting blend of the null results and also very large start results. So there are a lot of null results paper written in the profession that always begs the question of whether it's really documenting valuable, precisely estimate zero, or it's kind of documenting the failure of the power of the econometric methods, or it's really about the noise of the data. And the contrast between the null results of the referendum and the start result associated with the TCA really helps us to isolate the precise mechanisms of the Brexit event, the overall event on the economic performance or the trading volumes of the country. And the paper also has very rich, careful, detailed discussion of the institutional background and the policy details in terms of the tariff versus non-tariff issues, as well as the asymmetry between the UK and the EU and the asymmetry between the exports and imports. And all these details and very careful discussion of these asymmetries help us to really narrow down on what's really going on and I think very precisely about the mechanisms behind the facts that they document. And another usual exercise we would want to do whenever we find any null results or start results is to really delve into how much of heterogeneity there is. And that's what this paper really does. So they show very significant variation in the non-tariff hurdles across the sectors. And they also show substantial variation across sectors in terms of the export effects and import effects in terms of the effect of the TCA. So these are all very really nicely done aspects of the paper. So for the rest of the discussion, I'm going to raise various issues, and the whole point is to help the authors bolster the strengths of the paper and add some arguments so that I can address the potential concerns. So the first issue that I want to raise is the usual question about the parallel trend assumption in any difference in differences and an extension of the difference in differences. So this figure shows the overall trajectory of the UK as opposed to the rest of the EU, many of the EU countries. And this is not the figure that is intended to show the parallel trend. But just looking at the overall picture can help us to think about like what could be really going on. So let's try to think about the trajectory of the UK and EU countries in terms of the treatment of the TCA, which was at the beginning of at the end of 2020 or the beginning of the 2021. And from the point of view of that treatment, if you look at the period before that, you can already see quite a bit of divergence between the UK and many sort of comparable EU countries. So given that, we can see substantial divergence over time between the economic stance of the UK and the economic stance of other strong EU countries. It begs the question of whether we can make sort of convincing argument that in the absence of the treatment, the sort of UK-EU trade would have followed the sort of parallel trajectory to the UK and non-EU, OECD, and BRICS country. So yeah, so this sort of diverging trend between the economic performance of the UK and many other European countries is what makes us question this overall parallel trend assumption. And this was the case for the export. And so this divergence around here was the point. And if you look at the import figure, we also see sort of changes over time as well. So before the referendum period, you can see the UK is kind of sort of upward of this overall interval, overall range of the curve that you see. And after the referendum year around here, you begin to see the UK being kind of in the middle of the overall range. And again, the range is kind of getting larger and larger. So given that there's quite a bit of divergence, and the UK is kind of changing the status in this sort of interval of the European countries, you get to question whether there was really nothing structural going on before the TCA. And you can clearly also see this huge COVID effect going on. And from then, you can also see that basically UK is kind of at the bottom of the overall range of the European countries. So you can kind of see very structural changes going on in the imports and both exports and imports. And the overall picture of the GDP is not all that different. So kind of UK is getting more and more stuck at kind of at the bottom of the overall range. And there's quite a bit of divergence that you're seeing. So that was the first point about sort of identification assumption behind all these methods. So I would say that, you know, the authors have been very careful in trying to use, trying to basically complement difference and differences with triple difference and the synthetic control, etc. And I believe their argument roughly, but not exactly. So there's more room for addressing these issues. And my second issue, which is also a major issue, is actually about the COVID. So we have very small data period after COVID, and we also have very small data period after TCA. And it raises very fundamental question of how convincingly we can actually eliminate or separate the COVID effects on anything from the effects of TCA. So they try to deal with it quite carefully, but there are still remaining concerns. And there's more sort of fundamental question of whether we actually know the functional form of what the effect of the COVID cases and deaths should be or would be on GDP and imports and exports, etc. And they also make this argument that COVID is basically country-specific shock. So it would affect exports of the country I to all destinations in the same manner, and imports of the country J from all origins in a similar manner. But at the same time, if you think about the COVID effect very, very carefully, we kind of believe that the COVID effect varied quite substantially across different industries. And given, if we believe that it varied a lot across different industries, then the trading partnership that depend on different industries may also be affected very differently. So in a nutshell, the impact of the COVID that varied across the sectors may also vary across trading partners as well. So that was the first general point about the COVID. I also have a very specific point about the COVID in the UK. So somewhat concerningly, the timing of the TCA almost exactly coincides with the timing of one of the lockdowns or one of the spikes in COVID in the UK. So if you look at sort of overall graph of the curve of the death rates in the UK, you can see that there has been a huge spike in the COVID cases and the COVID deaths around the time of the TCA. And I remember it so clearly because there was a sort of lockdown in November, and there was a very strict imposition of the social distancing measures that let people really stay at home and let a lot of shops close as well. So I am concerned about the sort of separation or the distinction between the COVID effects of this spike in the UK and any effects of the effect of the TCA. And I also want to sort of propose a potential alternative interpretation of this asymmetry between import and export as well. So let's try to think about what's really going on between the relationship between UK and EU. So this divorce between UK and EU is what it was something that was initiated by the UK, which means that probably the animosity of the UK against Europe was probably much stronger than the animosity the other way around. And on top of it, in early 2021, so this is March 2021, EU took a legal action against UK primarily for the breach of the Northern Ireland Protocol. So the time after 2021 is really the time of the very severe animosity, political animosity between EU and UK, which was originally driven by the animosity of UK against EU. And there's a small pocket of literature in political economy and marketing that actually documents how the national identity or international conflicts affect consumer, basically instigates consumer boycott and potentially significantly affect consumer demand as well. So there's a published paper in Ristad that looks at international conflict between France and the US and how it affected the consumption or the demand for the French sounding American brand. And they argue that the international conflict does affect consumer behavior, consumer demand quite substantially. And there's also a recent working paper that actually looks at Brexit. So there's a paper by Sandra Sequeira, or working paper by Sandra Sequeira at LSE and Analoto at KU Leuven that looks at the effect of Brexit referendum. And they argue, based on 12 million observations, they argue that the Brexit referendum was associated with increase in consumption of the UK goods and substantial reduction in the demand for the EU products. And this is for the referendum. And this effect may have become around the time of the TCA with a even more substantial animosity by the UK against EU. So this could be something going on behind, along with other mechanisms behind this result. Now, I'm also kind of curious about the possibility of the asymmetric trading cost as well. So I am aware that in trade literature is quite conventional to model symmetric trading costs, but I think it would be more convincing if you can just look at some subsample of the trading costs and see whether the trading costs or the structural changes in the trading costs around 2021 actually looks quite symmetric. And it would also be interesting to see how the asymmetry or symmetry of the trading costs vary across different sectors. And this variation across different sectors could be related to the variation across different sectors in terms of the trading volume, the export volume, and import volume as well. So there's, I think there's quite a bit of systematic, interesting work that could be done regarding the possibility of the trading cost, structural changes in the trading cost, and the heterogeneity across different sectors, and the asymmetry between the imports and exports as well. Right, so I have one final sort of suggestion. So I think one of the really interesting variable strengths of this paper is this lots of potential to dig more into the heterogeneity across different industry. So this is one of the sort of early figures that the authors show in the paper. And as the author presented, there's substantial heterogeneity in the regulatory intensity across different sectors. So what I would really want to see is more systematic establishment, a documentation of the linkages between this cross-industry, cross-sector heterogeneity in the regulatory intensity and the cross-sector heterogeneity in the trading volumes, the imports, and also the asymmetry between imports and exports. So that would bolster the strengths of this paper in terms of really understanding the heterogeneity across sectors and also the asymmetry between exports and imports. So overall, I think this paper is really well done, pretty strong, and really smoothly and beautifully written. So I really value this paper a great deal. And there is a set of issues that let us think about how we can actually really improve the paper even better. And so we talked about four things, the quibble about the prior trend assumption and COVID effects in general, and also in the UK as well, and the possibility of asymmetric trading costs, and the really interesting observation of the cross heterogeneity in regulatory intensity and its potential relationship to the cross sector heterogeneity in the outcomes that we find, and also the asymmetry between two dimensions of the trade. Thank you very much.
Start. Okay, I do see somebody there, but I'm going to start anyway. So I was having a hard time thinking why there would be anticipatory effects on trade. You know, I mean, actually, Claire suggested a mechanism that wasn't anticipation, but it was just animosity. But I mean, that one aside, why would your trade flows change? Because the costs to doing trade are going to change in 3 or 4 years. And your instinct is that that might work for some sectors, but not for others. So, you know, I mean, for example, it would be logical to think that direct foreign investment decisions would immediately change, you know, and there maybe are some trade flows associated with those. But I mean, more generally, you would think that maybe using the sectoral heterogeneity, you know, if you could think theoretically about why there would be anticipation effects and then see if that maps onto what you observe in different sectors, that might be kind of interesting. And then my second comment, I don't know if there are separate Northern Irish trade data. I mean, famously, Northern Ireland has done better than the rest of the UK since Brexit. And okay, so it's different from GB in terms of having a land border, and it's different in terms of its sectoral composition. So you wouldn't want to hang a whole argument on it, but it would be interesting to see if their trade experience has been different. So that was my question. So who's next? I see.
Okay, thank you. Very, very informative paper. So,
Pierre Caïc.
Pierre Caïc. On the trade costs, similarly on the question of the asymmetry between import and export, could you get more information about the length of procedures, how these non-tariff regulations are implemented, the frequency of legal actions, or the delays to get agreements, because it could be a source of this strong asymmetry between a non-tariff cost.
Isabelle Méjean from Sciences Po. Just reacting on Pierre's, I think it's indeed an interesting question, in particular in terms of what we know already is that in terms of the border controls, they have been postponed by the UK. And I think, I mean, as far as I understand, it goes in the opposite direction. It should have helped with imports. And so, I mean, there is something around that is still, I think, very difficult to understand. And at least having a discussion on this would be very, very important and interesting. So in terms of my own question, so I think there is at least one theoretical argument why there could be some anticipation, and these have been put forward a lot in the literature, which is uncertainty. Like there has been massive uncertainty about trade policy, and we know from existing papers that uncertainty on trade policy has an impact on international trade. But what we know as well, or what we think we know, is that these type of effects are going to mostly materialize at the extensive margin, potentially not in a way that is not that different across different bilateral trade flows. And so if any, these type of effects are likely to materialize in the data in a very smooth way. So I was wondering how, I mean, given this effect that we anticipate, how the type of methodology you're using is going to capture this or not. I think it's going to be difficult identifying in the data with a definitive that is using a lot the time theory at the monthly level, this type of anticipation effect, which might be a reason for your new result. And the second point is about COVID. So I agree. I mean, it's always going to be difficult to fully separate what happened due to COVID and the rest. But perhaps at least to move on a bit in this direction, what we know is that COVID has had a very strong impact on the composition of trade. And in particular, a lot of trade has been created through the particular products that were meant to be used to treat the pandemic and stuff like this. And we have a very precise list of these products. So I think it would be interesting to have a bit of a more detailed focus on the evolution pre and post TCA of trade on the COVID-related products and the rest, so that we understand a bit better these composition effects that we know are there, are going to be difficult to detect in the data and are potentially important.
Yes. Thank you from me as well. It was fascinating. I one more question, maybe not for this, but for the next paper. So on one suggestion that I think you made, or that at least I took away, was for UK firms, the EU is very important. So they keep on exporting, whereas the EU firms exporting to the UK, for them, the UK is just a smaller trading partner. And so it's difficult to do, you don't do the paperwork that you need for exports. So I was wondering if you could look at then microdata from firms. Basically, this works if you only have one type of firm in the UK and they all export 5%, 10% to the UK, and so you give this up. But if otherwise you have 5 or 10% of firms in the EU that export everything to the UK, and it's more difficult to argue this, because suddenly trade to the UK is very important for you. So I was just wondering about going to microdata. Yes, Niklas Heusch from the Ministry of Finance here.
Could you explain? I'm trying to understand a little better the identification and the diff and diff and interpretation of your results, because if I look at January 2021, the trade deficit of the UK as a whole worsened. So I know that imports fell in that year, in that month, relative to the month before, but exports fell even more. This is just an aggregate claim just from the data. Now, you, through your diff and diff, say, well, the Brexit led to, not the Brexit, sorry, the agreement, my apologies, led to a fall in imports and no fall in exports as a causal effect of Brexit to EU, which given the aggregates, it's really about the comparison, meaning that they fell more with regards to the EU countries as opposed to the control countries. But once you reconcile your estimate, your causal diff and diff estimate with the aggregate, the only way this adds up is that the imports from other regions increase at that time, substituting such that you get the total adding up to an increase in the deficit. But once you start thinking about that these things have to add up and trying to make sense of your causal estimates and how to interpret them, you realize, or at least I realize, or let me pose the question of, a lot of imports are used to manufacture exports. Insofar as I'm importing less from the EU, I'm replacing that by importing more of whatever else from the United States to produce the same exports. You are going to call that the untreated and get your estimate from it. But trade being general equilibrium, I mean, you import less from the EU and you start importing more from the US, and that's how you did the replacement. But to then treat the US trade as the control in the diff and diff or in the treatment isn't quite right, because of course there was a treatment on the US insofar as it was Brexit that led me to import more from the US in order to replace one's EU. So once I try to square the micro causal estimates with the macro, I start questioning the identification assumption here of the diff and diff. I mean, how is it that we're treating the non-EU countries or even synthetic controls as being untreated, when in fact, a lot of the impact that we see on them is substitution of imports that now I'm not getting from the EU, but I'm getting from somewhere else. But if it's substitution, then the untreated have really been treated. So you see why I'm trying to reconcile your results with the aggregate, and then I end up questioning the entire exercise in terms of identification because of just substitution of imports one for the others. And those are affected by Brexit as well.
Okay, 2 or 3 minutes. Thanks very much. Let me say a few things quickly, then I'll hand over to Nico to see if he's got any responses he wants to make. First of all, thank you hugely for the detailed comments, for reading the paper carefully, to both the discussants. That was really, really helpful. I loved the comments, and we'll hopefully follow up with you guys. We'll follow up with you guys separately afterwards as well, and also for the great questions. Some of the questions, for example, with regard to asymmetric trade costs or to do with thinking about the regulatory differences in barriers, are really focusing on kind of asking us to think about, so you're finding these effects, what is driving these effects? And actually, we try to steer quite hard away from trying to explain the effects. What our main motive in this paper was to just, in the first instance, identify what are the effects, And I think there's going to be an awful lot of work to do subsequently in explaining what those effects are. To what extent is this regulatory barriers? To what extent is this asymmetric trade cost? To what extent is this restrictiveness in rules of origin? To what extent might this be differences between, you know, the role of fixed costs in market entry or and so on? There's a whole range of possible explanatory factors which we couldn't look into in this paper. The only bit that we did want to do, which we did do, and kind of potentially, if you like, inconsistent in terms of what I've just said, is to say, well, what is the role of relative market size? Because we thought that was potentially important and interesting, and to our surprise, the results came out quite strongly. Although, you know, thank you for your suggestions about how we might want to improve that. But again, even if relative market size is an explanatory factor, we still don't know why it is. So, you know, there's lots of why questions there, which I agree need to be addressed, but I really do think that is the subject of further work because the paper's already long enough. In terms of the asymmetric trade costs, I mean, this has already been said by one of the questioners. It's absolutely right that, in fact, the UK did not introduce the border controls in the same way as the EU did. So if anything, the asymmetric trade costs should have had more of an impact on exports than on imports, yet that's not what we're finding. Okay? What else did I want to say? In terms of uncertainty and anticipation effects, well, uncertainty, you know, anticipation effects may arise precisely because of uncertainty. So if you are worried that you're going to face future trade barriers, that may impact on what you do now. You may choose to trade less with particular partner countries, you may choose to invest less and so on, so that may have impacts now. There is some literature on Brexit and uncertainty, which the first discussant alluded to, but that doesn't tend to show an impact on aggregate trade. That tends to show an impact on firms exporting into particular markets. And, you know, we're talking about the Winters and Fernandez paper as well. It may be that for particular countries there may have been effects, but obviously we're looking at across countries, but maybe we need to go back and look at the Winters Fernandez paper. Look, there's lots of other great questions which I just don't have time to respond to, and I want to give Nico a chance to respond as well.
Yes, thank you, sir. I'll be brief as well. Many questions. Thank you. I'll go over the identification issues. I think the one of Ricardo and one raised in the discussion. I think you're talking about differences between trends in exports to the EU and non-EU having a substitution effect. I think when you talk about a difference in difference, that might be an issue. If you think about standard gravity theory, what that implies is that you have the multilateral resistance term that absorb essentially what you do with all other countries in the world. And that's something we can control for in our triple difference regression. So it's really a bilateral effect that we are going to identify there, and everything else should be controlled. There is something that would be in line with all the gravity literature, but we can discuss this later. And in terms of the parallel trend assumptions, something we have to remember in here is that our parallel trend assumption is always regarding the difference between trade with the EU and with non-EU, both concerning UK's trade and EU's trade. So that's the kind of parallel trend that we're really interested in. And when we look at the graph of these kind of trade flows, we see that they move very similarly before the treatment. So yeah, these are my answer for now, but happy to discuss them further with any of you later.
It was a very long, thin table last night, and I would have been yelling at the top of my voice to sort of say the thank yous that are normally said, and I thought it was just inappropriate because the whole restaurant would have heard. So we should thank the outgoing panelists, some of whom are here and some of whom are not. So Sophia, I think it's your last panel. Thank you very much. Edouard, it's your last panel. Moritz, Christine Laudenbach, Claire, it's your last panel, and Valeria. And then out there in the ether somewhere, we also have Federica, whom we saw yesterday, and Christopher Roth, who is sick, and so he's not going to be discussing in the next session, and Paolo Pinotti. So thank you very much to all of you. Thank you to the Federal Ministry of Finance for hosting us. Thank you to the State Secretary for speaking to us yesterday. So, and thank you to everybody who's been involved in organizing this whole event. It's been terrific. So thank you all. Now we have Roberto on Germany and target. So Roberto, you won't be able to see me waving bits of paper saying there's only 5 minutes left. So I'm going to have to rely on your ability to self-police in terms of timing. So you have 20 minutes starting from now. Off you go.
Thank you. Can you hear me?
Yep.
So, and can you see
Yes.
the screen, full screen? I'm trying to, is it full screen?
Yep. Oh, no, it's not quite. No.
Why is that not full screen? Why is, 1 second.
On the top by view, on the top, file edit view.
Okay, is it full screen now?
Yes.
Okay. So thank you very much for having me there, and apologies for not being there in person, but I couldn't travel for health reasons. So let me start with what is Target, because not everybody might be familiar with Target. Target is a real-time cross-border settlement system. It's used in the Eurozone by the Eurozone national central banks to record the claims and liabilities of each national central bank vis-a-vis the ECB. How do these claims arise? Whenever central bank reserves cross borders, essentially, and that happens when there is a payment via transfer of deposits between two persons or two companies in two different Eurozone countries, or there is a transaction between banks of different jurisdictions. Both are settled via transfers of reserves between national central banks. And to give you an idea of the orders of magnitude we are talking about, the Bundesbank now has a target claim of 1.3 trillion euros, which is a near the all-time high. So the key questions that have arisen in the debate is, first, in case of a Eurozone breakup, what would be the consequence of a default by a target debtor on a target creditor? And by implication, does it matter what the size of the target balances is? The second question is, because of this, do target imbalances influence unduly monetary policy at the Eurozone level? There's been a hot debate in the last 10 years on this. A number of German and Austrian economists mostly, and policymakers also, are on one side of the debate. And I think it's fair to say that most of the other European economists and policymakers are on the other side of the debate. This debate was not always clear to me, so you can think of this paper as an attempt at clarifying to myself what are the issues at stake. So let me give you an example of a target claim. So the typical example, the easiest example, is a current account surplus of Germany. So there are two guys, Pablo, who lives in Spain and has a deposit account at BBVA. Kurt lives in Germany and there's a deposit account at Commerzbank. At time zero, the two countries start with a balanced current account and zero net foreign assets. The interest rate is zero throughout. At time one, Kurt experiences a preference shock. So he wants to postpone 10 euros of consumption to period two. By sheer coincidence, Pablo experiences the opposite shock. So Germany runs a current account surplus of 10 euros at time one, a current account deficit at the same time as time two, the world end at time two, and the interest rate remains zero. So here is what happens to the balance sheet, the asset and liabilities, A and L, of different entities in Germany. Spain would be the mirror image of this. So the process starts with the BBVA, the bank of Pablo, sending reserves to Commerzbank, transfer central bank reserve for 10 euros to Commerzbank, delta R. So the assets of Commerzbank increased by 10 euros. And when it received the reserves, Commerzbank credits the deposit account of Kurt, who is exporting 10 euros of goods to Pablo, by 10 euros. So the liabilities of Commerzbank increased by 10 euros. The deposits of Kurt at Commerzbank increased by 10 euros. The Bundesbank has received 10 euros of reserves transferred from the Central Bank of Spain. And if things stopped here, it would have a decline in capital by 10 euros. So the ECB pencils in a target claim of 10 euros, which appears on the asset side of the Bundesbank, and it's a net foreign asset of 10 euros. It's a foreign asset of 10 euros of the Bundesbank. So the net foreign asset of the Bundesbank increased by 10 euros. The net foreign asset of Germany as a whole increased by 10 euros. In time two, the opposite happens because now Germany runs a current account deficit. Kurt wants to enjoy the 10 euros of consumption that he postponed from period one. So exactly the opposite happens. And the end result is that the Bundesbank loses 10 euros of target claims, and it goes back to a zero net foreign asset position. And Germany as a whole loses 10 euros of target claims, which is a foreign asset, because it's exactly the reverse of the previous period. But suppose that at the end of period one, the Eurozone breaks up. So the effect of this is that, and Spain reneges on the target liabilities that it has. So the Bundesbank loses 10 euros of target claims. If Kurt still wants to enjoy the same path of consumption, so he wants to consume 10 more units of consumption, he pays with deposits, but not, and so his deposit account at the Commerzbank declines by 10 euros. But now there are no reserves to be shifted between the Bank of Spain and the Bundesbank because they no longer belong to the same, to the Eurozone together. And so the transaction occurs via the Commerzbank crediting the BBVA account at Commerzbank or at correspondent bank if they don't have an account between them for 10 euros. So this is an increase in the liability or a decrease in the asset of Commerzbank vis-a-vis BBVA. And so the end result is that Germany loses 20 euros of foreign assets, the target claims which have been reneged on, and the increase in the liability of Commerzbank to BBVA or the correspondent bank. So Germany ends up with a net foreign asset position of minus 10 euros, starting from a foreign asset position of 0. So the default of the Spanish target liability does have real consequences for Germany. And this is the sticking point as well as I understand of the previous discussion in the literature. Germany loses a foreign asset, the target claim that it could have used to pay for the current account deficit at time 2. So in other words, if it wants to keep the same path of consumption, it must incur an extra net foreign liability, the 10 euro increase in the BBVA's account at Commerzbank, or if you are in a fixed exchange rate regime, this would be a loss of foreign exchange reserves or gold. And you could think of that as the central bank could have instead, if there had been no default on the target claim, it could have distributed the foreign exchange reserves of gold for 10 euros to its citizens and kept the same path of consumption of its citizens. So I think a target claim can best be understood as a token. It costs real resources to purchase, it cannot be cashed in, and it can be spent only in a given store to purchase certain items. If the store goes bankrupt or stops recognizing the token, other real resources must be used to purchase the same item. So it is the breakup of the store of the Eurozone is a real loss to the country that gets defaulted on its foreign on its target claims. Another example is the capital inflow to Germany. So Germany accumulates target claims if instead of selling a good to Pablo, could sells a liability like a bond, a capital inflow to Germany, or sells back a Spanish asset that he had previously bought. This is a capital repatriation to Germany. In both cases, Pablo pays via transfer of deposits from BBVA to Commerzbank, which in turn generates a transfer of reserves from the Bank of Spain to the Bundesbank. The difference, of course, is that in this case, there is no change in the net foreign asset position of Germany. Quantitative easing is a case in point. In itself, it doesn't have to create target imbalances, but many of the periphery country government bonds purchased by periphery central banks were sold by German entities, banks mostly, as part of capital repatriation strategy, or even by entities headquartered outside Germany, or even outside the Eurozone, but with a correspondent bank in Germany. So be as it may, since 2015, since the start of QE, German target balances have tracked very closely the public sector purchase program and the pandemic emergency public purchase program, which are the two main QE programs. So let me look at two defenses, what I think are the two main defenses of the target system. One is target claims are a risky asset, as risky as any other foreign asset. So this has been put forward by several people. As an example is a paper by De Grave and G in 2012. So the argument here is the target system has nothing to do with the risk of the country is facing. What matters is the size of its net foreign asset position, not its composition. So if you take the debt crisis of 2011-12, Germany accumulated large target claims because of repatriation of capital from the periphery. This did not change its net foreign asset position, only its composition. It was a substitution of target claims for government bonds, essentially. So this statement that the composition is irrelevant, only the size matters, cannot be true literally, because it would imply that all foreign assets and liabilities have the same risk. But more importantly, conditional on a disorderly euro breakup, a default of the target liabilities of the developed country is likely, because it requires just the decision of a bunch of policymakers who have all the incentives to play tough, both at home and foreign and outside their country. These policymakers could argue, and they would probably not be exactly in good faith, that they are liquidating the market value of an asset that is irredeemable. It cannot be used as a medium of exchange, and there's a zero negative effective remuneration, as I show in the paper. And the market value of such an asset is zero. And they could even cite the widespread view among academics that target claims are just an accounting device. And this leads me to the second and last defense of the target system. So target claims in this view are just part of a conventional capital of central bank. And just to give you an idea, the capital of the Bundesbank at the end of 2021 was about 200 billion euros, and its target claims were around 1.3 trillion euros. So a default on the Bundesbank target claims will lead to a large negative capital of the Bundesbank after the breakup. So there are two very different views about what are the implications of negative central bank capital. Essentially, most academics, I think it's fair to say that they would say it's irrelevant, and most policymakers and central bankers would just be horrified at the idea of having negative central bank capital, even for one day, even for €1. In fact, the Constitutional Court of Germany has stated that any negative capital should be recapitalized immediately. So as a consequence of this, there are two arguments, I think, why target default is irrelevant, and these are well summarized in a paper by Whelan, 2014. In a fiat money world, central bank capital is irrelevant because the value of fiat currency depends on its supply and demand. The value of fiat currency is the inverse of the price level. The second argument is that in any case, recapitalization of central bank is costless to the private sector anyway. Suppose the government gives the central bank interest-bearing government bonds to recapitalize it. This is just a flow of resources within the consolidated public sector that includes the government and the central bank, and doesn't change the net asset position of the private sector. Target receipts in this exchange are transferred from the government to the central bank, and the same amount in present value terms comes back to the government in the form of higher dividends from the central bank. This argument is correct, but I think it can be easily misunderstood. I think it has been misunderstood. A recapitalization is neutral, conditional on net foreign assets, the target claims of the central bank having been lost, but losing the target claims because of default or any foreign asset is not neutral from the private sector for the country as a whole. It's a real loss, as I think I've shown before. The last point I want to make is that critics of the target system have put forward a tentative solution, which is settlement. So the idea is that imbalances in target claims should be settled periodically every 6 months or 1 year. And they argue that the Federal Reserve System is such a system with a periodic settlement of imbalances between Federal Reserve banks. In fact, in the Federal Reserve System, a Federal Reserve Bank with a negative balance receives a smaller share of essentially the assets of the Federal Reserve System as a whole, so it receives less seigniorage. However, the fact is that all earnings generated in the Federal Reserve System are remitted to the Treasury after paying the stockholders. So their distribution is in reality irrelevant because anyway, they all go back to the Treasury. The second point to note is that it is virtually impossible for the Federal Reserve Bank to run out of government bonds and agency securities, which are the two assets usable for settlement in the Federal Reserve System. So one has to understand that the settlement in the Federal Reserve System was not meant to be a protection against the breakup of the United States, which is unthinkable, but it's a system to allocate profits equitably, even though this is just a nominal thing, because as we have seen, in the end, all the profits of the Federal Reserve banks go back to the Treasury anyway. In the Euro system, the goal of an equitable distribution of profits among central banks should be taken care of in theory by a correct remuneration of target balances, even though even this is an issue of which I talk about in the paper, but I don't have time to address here. The goal of settlement in the Euro system is to insulate the creditor, national central bank, from the risk of default by the debtor national central banks if you have a breakup. And something that has not been appreciated in the literature, that for this to happen, settlement must be in what I call breakup-proof assets, so assets that cannot be manipulated by the target debtor, obviously. And almost by definition, these cannot be assets issued by a public entity of the debtor country, and maybe not even by a private entity. However, virtually all proposals of settlement that have been put forward do violate this requirement that you have to use a breakup-proof asset. So the type of asset that can have been proposed to collateralize target liabilities are senior claims to state-owned real estate or future tax revenues, which obviously manipulable and renegable by the debtor country, collateral used in refinancing operations, and assets acquired via QE, which are mostly government bonds of the debtor country. SIN has proposed gold or European safe assets. Both assets, excluding maybe European safe assets, because they do have a component of the debtor country, are breakup proof, but the amount of these assets on the balance sheets of national central banks are minimal at the moment, and they will be minimal for a long, or maybe forever. So simply, national central banks of the Eurozone do not have enough breakup proof assets to even come close to being able to settle their target balances. So insisting on the settlement of target balances would almost certainly cause a breakup of the Eurozone as we know it. So to conclude, here in this paper, what I've tried to argue is to show is what are the possible consequences of a breakup of the Eurozone when there are large target imbalances. Now, whether this is a problem, a real problem, a serious problem, is debatable. You can think of the paper as describing a sort of upper bound to the potential losses of a large target creditor in case of a disorderly breakup, and disorderly is the key adjective here, when there is full default of target liabilities. So it's a kind of a Armageddon scenario, but I think it's useful to understand the, first of all, the upper bound, and second, whether default on target claims is or is not a real loss to the creditor country. And on this, I tend to side with the German and Austrian side of the debate. The default on target claims is a real loss to the creditor country. Thank you very much for your attention.
Okay, I don't know where to put. So thank you for having me discuss this paper. It was very interesting for me to read. I didn't know anything about the target system before I got the paper or about the debate around it. So I think I had a kind of fresh mind at it, and I looked into the literature a bit. So I enjoyed reading the paper because I learned a lot from it, and I largely agree with the conclusions of the paper. What I found a little bit hard is when reading the paper, is to really understand what the message of the paper is in the end. And so what I got from the paper is that the default on the target debt has a real cost, but I would be a bit more, I would question a little bit for whom this is costly and to what extent. And the second message that I found is that the target system with settlement would just make things worse. So it wouldn't improve anything if we would, if the target debtors would now be asked to settle these balances. And I would like to raise a few broader questions that I think put this debate about whether the target debt is a really big issue or not into perspective. So what did I find out about the target system? I found out that this was put in place in 1999, shortly after the euro was introduced as a single currency. And the goal of this target system is twofold. One is to support monetary policy operations. So I think it is necessary for the euro to operate as a single currency. And second, it is to settle euro payments that goes across national borders within the euro area. So this is a real-time gross settlement system, which means that every time a transaction is made across countries, the electronic accounts of the respective central banks are adjusted to take this into account. So such systems exist in every country, where the national bank of the given country adjusts the accounts of the different banks of the country. But this is a system which does this across countries. This is a huge system. Okay, so in 2021, the average number of transactions in a day was 380,000, and the value of these transactions was 1.9 trillion euros. Okay, on a single day. So it's a huge system. It was not designed with having these large imbalances in mind. So that wasn't how it was imagined. I think it was initially largely balanced. But then these imbalances started to accumulate. So I think people agree on why these imbalances started to accumulate. And it starts with the current account deficits of the so-called periphery countries before 2007. And after after the financial crisis, or after the start of the financial crisis, a lot of German capital was repatriated from these countries. So that's where they started. And then after 2011, there was further capital flight from these countries. So not repatriation, but rather even, people living in these countries prefer to take their capital somewhere else because of fear of a banking or financial crisis locally. And then quantitative easing in 2015 and 2019, and the emergency purchase program just made these, I think, exacerbated it even further. So here is just a view, just so you see what this looks like. So this is target imbalances until 2007. Okay, you see that these are all quite close to zero for these selected countries. And then from 2007, basically Germany starts to accumulate a target claim, and other countries start to accumulate a target debt. Now note that the target, so this ends in 2012. Unfortunately, I didn't find any paper that would show this further down the line, and I don't know how they got this data, so I couldn't make a graph for you showing this until 2021. But you see that none of the countries individually have such a big debt. It's just the sum of the debts add up, and most of this ended up as a claim in Germany. Okay, so there was in the 2010s there was a huge debate about this, and the basic argument, or the source of the debate, was that certain people said that Germany, via these target claims, are basically bailing out the target debtor countries, and this is a stealth bailout that is not visible. Okay, and basically the argument was that if there would be a default, then Germany would bear the burden of the default by the target debtors, and even if there isn't a default, this debt is crowding out funding for German banks and the German private sector. And finally, the rate at which this debt is increasing over time is not sustainable. So that means that eventually this is going to lead to a default on these debts and a breakup of the Eurozone. So since then, I think, so this paper is mainly about this first point here, whether Germany will bear the burden in case of a default of these target debts. And I think for the second 2 points in this initial debate in a decade ago, it has been shown that this is not the case, so that there is no crowding out of these via these target claims for German banks to provide basically debt for German banks and the German private sector. So this is not really the case. And in the beginning of 2010s, they were already saying that this is unsustainable. Since then, these claims have more than tripled. Okay, so when this debate started, it was 300 billion, and today it's like 1.2 trillion, and it still has not collapsed. So it's very hard to know where the breaking point is. So I think Roberto explained quite clearly why a default on the target debts is a real loss, independent of how these debts were accumulated. But I think so, and he concludes from this that the size of the overall target debt is important. But I think there are other things that are equally important besides the size of the target debt. So the one is the likelihood of the default. Okay, so if there is no chance that there will ever be a default, then this is irrelevant. So the question is, how likely is a default on a single target debt, on a combination of target debts, or on all target debts together? That's one thing. The second thing is that these losses, so if there's a default, that's a loss for the ECB. And according to the regulations, the losses of the ECB and the gains of the ECB are shared according to some capital keys, where Germany has, I think, a capital key of 27%, and France, for example, has a capital key of 20%. Okay, so if after a default, the losses are shared in a way that they're meant to be shared, then it doesn't matter that the target claim is with Germany rather than with France, because they will share these losses according to these capital keys. Now, if the losses are not shared, so if the if it's just a blown breakup, then of course also the size of the target claims matters. But if it's not, then we also have to think about these capital keys here. And then Roberto revisits some selected set of arguments against the notion that these target debts would be a real loss. Defaulting on target debts would be a real loss. And I think here I want to make 2 points. One is related to the NFA position. I completely agree with the assessment that the NFA position, the size and the composition of this matters. But I think the key question is whether the target system did that make the NFA position of Germany more risky or not. So before, like Germany already had why did Germany want to repatriate capital? It's because they had a lot of capital there. So they owned a lot of, kind of low quality, what they determined at some point, they decided that this is a low quality investment. They wanted to get out of it. Now they got out of this because these countries could accumulate a target debt. So is having a target claim worse than having had to hold on to those assets in the first place? I don't know. That's one thing. The second thing that Roberto didn't mention, but it's in the paper, is that some people argue that whenever we think about the target claim, we should also think about the net issuance of banknotes. And in that sense, Germany has a big liability against the ECB because it issued much more banknotes than what is used in the country. So a lot of the banknotes that are issued by Germany are used in Spain or in Italy, and these show up as liability on Germany's account towards the ECB. Now, if there is a full-blown breakup of the Eurozone, then maybe Germany is going to default on this liability, and that's about 600 billion euros. So it's about half of the target claim. Okay, so I think that we should think about that as well. Whether Germany would default. And so I completely agree with the fact that the target system with settlement would make things worse and actually could lead to could trigger a breakup of the euro. But Roberto suggests in the paper that maybe there should be a target system with a cap on the imbalances. And I think this is not a very good idea, because what would happen if the cap is reached? Okay, so imagine that Spain reached the cap and a Spanish person wants to buy, something from France on the internet. They wouldn't be able to pay for that. Okay, so that would mean that a Spanish euro wouldn't be the same as a French euro. And that again would lead to the euro as a single currency not functioning anymore. So just to finish, I want to put this in a little bit in a broader context. I think these imbalances arise because the shocks that hit the different countries of the Eurozone had an asymmetric impact on the different countries. And actually, these initial imbalances prevented banking crisis in the debtor countries. And by this also prevented the rollover of this crisis to other countries, to the whole euro area. So I think it's true that, this imbalances helped the debtor countries, but I think it also helped the claimant countries in the sense that it protected the financial or the banking system of the Eurozone. Also, as long as the euro functions as a single currency, the size of the target debt is irrelevant. So the question is, how large imbalances can the system bear? And, in the beginning of 2010, the 2010s, people already thought that we're reaching the limit. Now we're more than almost 4 times at that level, and it's still not collapsing. I don't know, but are there alternatives to the target system in a monetary union? What else could we do, right? And if the euro collapses, are these target debts really the biggest issue? I mean, if the euro collapses, there would be such uncertainty and huge change that would have huge distributional impacts that I think would be much, much bigger than these target debts that, might be offset with the liabilities due to net issuance of banknotes, etc. And finally, I think that just looking at the value of the target system on its own is a kind of futile exercise. Maybe the value is we should look at the value of the monetary union together with the target system, not just take up one side of the system and see how bad a debt there can be for a country, but also look at the gains from being in the monetary union. So that's it for me. Thank you.
Okay, a lot of things to say, but let me keep it short. So first of all, congratulations to Roberto, who I think really clarifies very much some of these issues, which I think some people understand, but there's a lot of confusion around them. And I found the paper extremely clear and a welcome addition, especially in correcting, I think, some misperceptions that came from the Whelan paper in economic policy. And so let me start by saying that I think Roberto got it just right on everything. But then two comments, one in three parts. As Sophia noted, I think it would be important that the first page of the paper says theorem 0 is if there is no breakup of the Eurozone, these target balances are irrelevant. As Sophia noted it, Roberto, you noted in the paper, but it's important to say from the first, because I think you're being a little too kind to the German, Austrian economists, because they're saying this really matters regardless of whether there's a Eurozone breakup or not. And I think everything you say in this paper is contingent on if there's a Eurozone breakup, this matters. Otherwise, it does not matter in many ways. Second, you're also, I think, being a little too harsh to academic economists when you say they think that central bank capital doesn't matter, because as you know, 10 years ago, I wrote a lot of papers with Bob Hall, noting how central bank capital matters for the reasons you said. So, and I'm not a central banker yet, so I think there's some academic economists that think central bank capital matters. But third and related, an observation that we've had an increase in central bank swap lines across different central banks. They actually work just like Target 2. So I think you would improve the scope of your paper by noting in a paragraph, these large swap lines, every point you make applies to the swap lines between the Fed, between the Chinese central bank. So I think actually the points you make are more general and more important outside of the Euro area because it would apply that. But my second comment is on QE. And here on QE, there's a little bit of confusion in the paper that I'd like to ask you to clarify. You start by noting quite correctly that QE is just like a capital repatriation. But then when you look at the criticisms of whether this matters or not, you say, well, the composition matters, not just the total when we think about the breakup. However, let's think about QE in isolation, because these points are general and then when combined can lead to a logical fallacy. If scenario number one, if when we leave the Eurozone, we default on our sovereign bonds, we, the Spanish, say, then target 2 QE was irrelevant. The losses to net foreign assets are the same. I used to default on a government bond. Now it's the Bank of Spain defaulting on the Bundesbank. And QE actually didn't make any difference, I think. So again, tell me if I'm wrong. Therefore, yes, in this case, the target 2 is irrelevant insofar as it didn't really change anything because the default on the 2 is exactly the same. That's case number one. Case number two, which is one that you're implicitly ultimately saying in the paper is, well, there's a breakup of the Eurozone, but Spain would honor its government bonds held by Germans. Then that's the conclusion you reach, which is, yes, then the target 2, QE, by increasing the target 2 balances, led to a loss to Germans in that event. And that I think you're correct. Of course, there's the third scenario, which is the Spanish default on government bonds, but they stay within the euro. In that case, note that QE via target 2, by the reverse of your arguments, actually increased the net foreign assets of Germans because they now got a liability of the Bank of Spain when they had a liability of the Treasury of Spain. And as a result, they're now much more insulated than they were before. So I think separating between these three cases is important because right now, reading your paper, it seems like QE, by increasing target 2 balances, left Germans worse off in a probabilistic sense, given that probability that there's a default, say, by Spain. But that's because you are kind of implicitly, when in doing that, or at least one could read your paper, saying that the Bank of Spain would default, but the Spanish Treasury would never default. If they're equal, then QE made no difference, I think, the net foreign assets. And if instead, which I think is the working assumption, that Spain may default, the Ministry of Finance, but the Bank of Spain will not leave the euro, then actually, I think the conclusion from your paper is that QE, if anything, benefited Germany quite significantly, meaning increased the net foreign assets in the state of the world. So I want to tell me whether I got this right on the second question, Roberto, because I think that's what I understood. And maybe you didn't mean to say what you said, but you do, reading your paper, it does sound like you're saying that QE, by increasing target 2 balances, has left Germany worse off. And I think it's exactly the opposite, because I think the more plausible is that Spain defaults, but the Bank of Spain does not leave. Sorry for taking so much time.
Thanks. Yes, great paper and very useful comments. I have one question to Roberto and also to the to all discussants. In fact, I think that the real issue here is, do these balances matter while the euro exists? I think a breakup scenario is not very realistic, although it can never be ruled out. The way I always thought about this would be to say, okay, breakup is unlikely, but if we bargain all the time about continuation of the currency union. And in the most standard bargaining models would say, okay, if the fallback is the breakup, it will influence the bargaining, meaning these target balances are undermining, or maybe undermining, the bargaining position of the creditors, right? And insofar they would matter for, without breakup. And in that regard, this fundamental theorem would not be correct. But I'm not sure if that's true. I'd love to hear your views on that. Thank you.
So I found it very interesting, the topics of discussion. I've done a lot of work on settlement systems, and what I was surprised was the lack of a discussion on the benefits of the target system over these years. For instance, the alternative to a real-time gross settlement system would be a net settlement system, like automated clearing houses and so on. But this exposed banking system to credit risk and a lot of idiosyncratic risk in them. I mean, doing away with the target system would require a system, something to replace. And that would require banks' bilateral transfers, which may not be satisfied and may not be paid upon. So I was, in defending the target system, I thought this would be a prominent issue. In fact, we have, some work with my co-authors just published. We show that the arrival of the real-time gross settlement system in Africa solved issues of liquidity across the board for both receivers and senders of payments, because eliminated the settlement risk, which is large and requires a lot of time and obliges banks to keep enormous precautionary holdings to deal with this risk. So I understand the scope of the paper, but I was surprised that it was missing, the banking aspect of it that is prominent and is the real existence of these systems.
Moritz online. Moritz Schurek.
Yes, great. I hope you can hear me. I wanted to echo a few of the things that Ricardo and Clemens just said. So I think this is a paper that says in various places, the problem occurs when there is a break above the Eurozone, but the paper itself is all about the functioning of the system while the Euro is in place. And I think there's certain opposition that uses sort of this image of this is a functioning system that is perfectly fine, and these imbalances do not matter as long as the currency union exists. But it could be a problem in the case of default or breakup, but then you never talk about it. And I think that's what Clemens also meant. Like, is there a way that you can say this matters even today? I don't know. I'm not sure. I'm convinced that there is this bargaining, but it could be. It's a nice idea that Clemens had. So, you talk about something that matters in the case of default, but you never talk about what actually happens in a default, or how could that matter before default. And I think that is something that I'd like to see. And the other thing is, I still think there is you're still a little bit too kind to these German economists, because you sort of use their language in terms of active, as if they were active decisions on the side of countries, right? A central bank's target claim, you called it a token, but the central bank that has this target claim has no active role in acquiring. It cannot choose to divest it. It is literally a bookkeeping entry. And the same is true, like the central bank the acquisition or divestment of this claim is an increase or decrease of the central bank's debt relative to commercial banks. This is not something where you can buy a BMW for. And unfortunately, in the public debate, it was often confused. So I think here too, it would really help to be a little bit, to be more precise and actually say what the this act. I'm struggling a little bit with this, like making this active as if there are two countries acting and have persona here in economic affairs. Thank you.
Thanks very much. So I have a question, Kevin O'Rourke. So I thought Sophia kind of nailed it for me, actually, which is that, I mean, if you run a current account surplus, by definition, you're not getting stuff you can consume in return for your exports. You're getting assets of one sort or another. So you're either getting little bits of paper saying, I'm going to pay you money, but that's risky, or I guess you're accumulating reserves, or in the context of the Eurozone, you're accumulating target balances. But, if it's reserves, the dollar could lose its value, gold could lose its value. Little bits of paper saying, I'm going to owe you money, in the next 20 years, they can lose their value. I mean, it's just you're taking a risk if you run a current account surplus. I don't see that you can get away from that. And surely target zone balances are particularly riskless, because actually for you to lose your money, you would require the Eurozone to break up, which is probably quite unlikely. So it's a very safe way, I would have thought, of doing this kind of thing. And if you were really concerned about this particular risk, maybe you could have some sort of rule, like every time we accumulate a certain amount of target zones, we could increase our expenditure by a certain amount and avoid the risk that we would end up not being able to consume as many resources as we otherwise would have. The thing was just being rude, really. I didn't really mean that, but as a serious policy proposal, but that would be the solution, Okay, is there anybody else? No? Okay, Roberto, the floor is yours.
Well, thank you very much for all the comments. So let me start with the general comment that came up. So obviously, this is about the case of a default. We all agree that in the absence of default, there is no problem. Why does it matter? Because it could conceivably change the bargaining power. And I think this is a point that has been made by some German economists during the debt crisis in 2011-12, that the threat of a default on target imbalances forced, in their view, the central bank to have a much looser monetary policy than otherwise it would have had. It could conceivably change the bargaining power within the ECB of different countries, in particular increase the bargaining power of debtor countries. So this was the general comment. Let me take up the more specific comments. Thanks, Sophia, for all the comments. Let me go through the main ones. Cost of a default for whom? Well, this is certainly a default, a real loss to Germany. Where who actually loses within Germany? It's a question of distribution. Depends on the reaction of the government, but it's a loss for Germany as a whole. You mentioned that if there is a default, the loss would be shared. Well, that's not clear. I'm talking about a disorderly default. Clearly, in case of an orderly default, everybody would keep up their promises and their debt. In case of disorderly default, well, there is no mention of what would happen in the treaties or in the EC statute, the ECB statute. But it's perfectly conceivable that Spain and the Bank of Spain would default on their target liabilities. And I'm going to come back to that, what it means to default on the target liabilities. Another general point was that Kevin also mentioned, are target liabilities more risky than other types of liabilities, that assets that you would accumulate with the current account surplus? not necessarily, but my point is that in a disorderly breakup, it's very easy to default on the whole of your target liabilities if you're the target debtor, while it's much more difficult to think of a situation in which all the private debtors default 100% together. Sophia mentioned the liabilities on excessive money creation. Would Germany default on that? I don't think it would, because once the Eurozone breaks up, Germany has everything to gain, because it would gain a lot of seniorage on each issuance of currency. If the euro collapses, is target the highest problem, the biggest problem? Probably not, but that doesn't mean that it's not a problem that merits attention. And we should balance the gains from the euro against the disadvantages from imbalances. I totally agree. The fact that target could be a problem, I'm not saying it is a problem, but could be a problem, doesn't mean that the euro is a bad idea, or doesn't mean that the target itself is a bad idea. Certainly not. So let me come to Ricardo's point. I apologize for the part on capital, central bank capital. I know your work, and in the previous version of the paper, I had a long section on the issue, which I essentially eliminated in this version of the paper. But I'm aware that there is a large debate on the role of capital, and that you took didn't took the position of most of the other economists. On your question about what would happen if the Spanish government defaulted on government debt, I'm not sure I followed exactly your three cases, but I don't know if it helps, but if the Spanish government defaults on the Spanish bonds, in the current situation, the loss would be taken by 80% of the loss, almost all of it would be taken by the Bank of Spain, not by the Euro system as a whole. So I don't know whether this helps or not, but according to the rules of QE, the losses on the Spanish government bonds would be almost all of them on the Spanish.
Yes, Roberto, but that's post QE, right? But the question is, before you did QE, there was a German guy holding the bond. Now, afterwards, absolutely. But before you did QE, there was a German guy. And so but after you've done QE with Target 2, now you've saved that German guy from the default.
I'm not sure I follow you. So this is something that I would certainly like to understand better, to get deeper into. I can't follow you right now. It's certainly my problem. So maybe we can talk later. I apologize, but certainly an important issue, understand. So let me skip, because I'm not following you exactly at the moment, but let's talk, if you have time, we can talk later about that. So the last point is Moritz. I'm not sure your point. Well, you're saying you talk as if the countries acted as if they acted as individuals. Is that your point? And that in reality they have no choice. In a breakup they have no choice. I'm not sure. Is that your point?
Yeah, I mean, for brevity purposes, yes, take it as this token idea. Supposes it gives agency to central banks or institutions that just don't have them. This is not a token with which you can buy a BMW in the real world.
I'm not sure, because the decision to renege on the target liabilities is a decision that you can take or not take if you have a disorderly breakup. We are always talking about the disorderly breakup. So the Spanish government and the Spanish central bank can decide to default on the target liabilities or not to default, and that makes a huge difference. So I'm not sure I understand your point.
Right. I think we should move. The point is very simple, that this is not a claim vis-a-vis the private sector, but the debt between the central bank and commercial banks. So anyways, this token idea, I think, is just misleading in the sense that this is not some payment money with which you can buy anything. But I think we're back to the point where all of this is relevant in the case of a breakup. But the analysis in the paper is not about the breakup, but about the current working of the target system. So I think there's the main opposition. That was my main point, really. So I think it would be really nice to have more about what actually happens in a breakup. How does all of this matter in the world where there is no breakup, which is the one we are in, and obviously, arguably, with a low probability for that occurring.
Or are we done? No further comments, Roberto.
No, I think I apologize if I forgot to respond to some comments, but I think I did respond to all comments, I think.
Oh, and we're bang on time, so it's 10:40. So we have 15-minute break and we will resume at 10:55. So thanks all.
Roberto? Ciao Roberto, non so se mi senti, sono Nicola Limodio
Ciao.
di Bocconi. Ti volevo dire,
Ciao.
ora c'è ancora break, poi ti manderò
Sì.
una mail,
Sì.
però I've done a little bit of, sorry, I switched to English for courtesy to the rest.
Yeah.
I asked you one of the questions. If you don't mind, I'm happy to send you a paper. It's not related to when you're presenting about a real-time gross settlement system between central banks. So it's kind of, cross-border. But what could be nice, I have a paper looking at the introduction of real-time gross settlement systems and how that affects has real effects on banks because it eliminates settlement risk and credit risk. And those seem, now I know your paper is more on the accounting side, getting the accounting right of the losses in case of default.
Mm-hmm.
But I thought that one key benefit of Target 2 was that of eliminating uncertainty between financial institutions participating in the system. And so that was, something that could be, nice to have even a paragraph or a footnote somewhere, because that seems to be the key advantage of the system.
Yeah, no, absolutely. I mean, a settlement system is necessary in any case. So obviously it has enormous advantages. So just think a Eurozone without even an individual country without a settlement system between banks.
Without fast payments across countries. I mean, that's
but there's no question that the settlement system is necessary. But so I don't think there is a solution to the problem because the solution is not getting rid of the settlement system, of course.
No. It's just thinking about what would be without. And,
exactly.
What we saw in Africa was interesting, that basically many central banks and commercial banks started to adopt a real-time gross settlement system when internet arrived. And so we use this variation to tease out whether and how that affects the liquidity of banks. And it does. So banks start, holding a lot less, holding, cash and other liquid assets to deal with these settlement risks that were there before. And, this has an effect on lending and on investment and so on and so forth. So anyway, I'll send you the paper.
Thank you.
No obligation.
No,
just, to say that I've been thinking about these questions. They are very interesting. And there is not so much work on settlement systems. And so, I enjoyed what you presented and wanted to share.
Thank you. Yeah, no, do send me the paper. I will be interested in reading. Thanks. Yeah.
I'm downstairs in the dark of the second floor of Runge building. So, we don't meet often, but I'm an economist as well. So
okay.
Lovely. I'll write you.
Thank you.
Municipal finance. So you have 20 minutes starting from now.
Thank you very much. Thank you very much for the opportunity to present our paper, The Effects of Natural Resource Revenues on Municipal Finance. This is joint work with Patrick over there and Jonas Röllin and Christoph Schaltegger, who are not here. How do local authorities use exogenous revenues? Local authorities can use exogenous revenues that are independent of their decisions as any other revenues. They can spend them and finance public services, or they can return them to citizens through debt and tax reductions to finance private consumption. Indeed, standard theory predicts that the distribution between public and private consumption only depends on citizens' preferences and not on the source of the revenues. However, many studies document much larger spending effects of exogenous revenues compared to those of income. And such discrepancies are evidence of distortions in setting and implementing policies. Therefore, the use of exogenous revenues provides information on the functioning of the political process. Our paper provides fresh evidence on this question for a setting uniquely suitable to address this question. First, we have a setting with large and predictable exogenous revenues. And second, we have a setting with strong fiscal autonomy and participatory institutions. Therefore, the policies can reflect citizens' preferences. Our setting are the water fee revenues, a kind of royalties that Swiss communities receive from hydropower companies using their waters. And our research question is, what are the effects of local fiscal, what are the effects of water fee revenues on local fiscal policy? We address this question with an unbalanced panel of 235 municipalities. So we estimate effects of water fee revenues in this with this panel data. And to isolate exogenous variation, we use the water fee potential as a instrument. The water fee potential combines the time invariant hydropower potential and time varying federal rules. Our simple fixed effects estimates suggest that the expenditures increase roughly 1-for-1 with water fee revenues. In contrast with the IV estimates, we find no significant effect of water fee revenues on spending, but strong negative effects on taxes. In the interest of time, I skip the previous literature, but I'm happy to come back to that during a discussion. Let me give you some additional details about the institutional setting and the exogenous revenues. Switzerland has 3 levels of government: the federation, the cantons, and the municipalities. The municipalities have strong fiscal autonomy. Their main revenue source are personal income and wealth taxes levied by a surcharge on cantonal taxes, and this surcharge is called the tax multiplier. Voters can decide on all important decisions, including the size of the tax multiplier. Our source of exogenous revenues are the water fee revenues. The municipalities receive these revenues from hydropower companies using their waters. They are levied based on the capacity of hydropower plants, and they depend also on a federally legislated maximum rate, and this makes them very predictable. Over our sample period, the federal maximum rate almost doubled in real terms. This is shown here. And the cantons and the municipalities split the water fee revenues. The municipal share is 50% in Grisons, one of the cantons we look at, and 40% in the canton of Valais. So we look at 2 mountain cantons for which these water fee revenues are very important. For around 45% of the municipalities, the water fee, around 40% of the municipalities have no or almost no water fee revenues. For the other for some other municipalities, the water fee revenues account for almost half the revenues. On average, the water fee revenues as a share of total revenues account for 6.6%. So this is a substantial source of revenue. We are interested in the effects of these water fee revenues on local fiscal policy. Therefore, let me briefly explain how they are calculated. Let me look at endogeneity issues associated with simply regressing local fiscal outcomes on water fee revenues and at how we deal with this endogeneity problem. The water fees owed by a hydropower plant on a stream segment J in municipality I and year T are simply the product of the capacity of the plant times the federal maximum rate. A municipality's water fee revenues depend on the capacities of all the hydropower plants using its waters. And we can think of this total capacity as the summed potential capacity at all stream segments multiplied by the degree delta to which the municipality develops its potential. Therefore, we can express the municipality's water fee revenues as shown here. The parameters delta and sigma and chi here denote the municipal share of water fee revenues and contractual arrangements with power plant operators. So this expression simplifies reality because we assume all factors to be linear. Most of the elements here are clearly exogenous. They are neither influenced by nor targeted towards a specific municipality. There are two exceptions. First, the degree of capacity development and the contractual arrangements are clearly endogenous. For example, some municipalities may promote local economic activity with low infrastructure spending, low taxes, and hydropower exploitation, or other municipalities may push for hydropower development in order to cover large expected financing needs. To address this omitted variable problem or these reverse causality problems, we isolate exogenous variation in the water fee revenues with an IV approach. As shown here, we can further decompose the water fee revenues into their long-term average, which depends on local average precipitation levels, and the short-term deviation from this long-term average. If we then collect the terms in the square bracket here, we get the hydropower potential. The hydropower potential depends, as you can see, on topographic factors, on hydromorphological factors, and on climatic conditions. So all exogenous factors, and the hydropower potential measures the average amount of electricity the municipality could produce if it fully developed its potential. If we now multiply this hydropower potential by the municipal share and the federal maximum rate, this gives us the water fee potential. The water fee potential measures the amount of water fee revenues a municipality would receive on average if it fully developed its potential. It captures the exogenous, the predictable exogenous long-term variation in water fee revenues. It is our instrument. Here you can see the large variation in the hydropower potential across the municipalities in our sample. And as you can see here, the actual water fee revenues closely mirror this hydropower potential. We estimate the effect of water fee revenues on the following local fiscal outcomes. We have the current expenditures, current revenues, net investment, the tax multiplier, tax revenues, and net debt change. Current expenditures and current revenues are broad categories capturing all financial flows that are not related to investment. The investment figures are much smaller and more volatile. Therefore, we have to be careful in interpreting the net investment figures. And the tax multiplier is interesting because it directly captures political decisions without any noise. In contrast, the other outcomes also depend on factors beyond the control of the municipalities, and they exhibit substantial year-to-year fluctuations. In our regressions, we include municipality effects, canton-specific year effects, and we also include municipality-specific time trends. As I have shown before, the federal maximum rate has a clear upward trend. Therefore, one might be worried that the water fee potential, which depends on this federal maximum rate, captures differential trends between municipalities that are suitable for hydropower production and those municipalities that are not. For this reason, we include municipality-specific time trends, but as I will show, this decision is not innocuous. Throughout, we use cluster robust, or we estimate cluster robust standard errors at the municipality level. We estimate, we have an unbalanced panel for 235 municipalities. For the canton of Grisons, we have data for the years 2004 to 2015. For the canton of Valais, we have data from the years 1987 to 2015. Most of the fiscal data come from cantonal statistics. The water fee revenues for Grisons directly come from municipalities. To construct the water fee potential, there are two key ingredients. The first key ingredient is the federal maximum rate, and the second is the hydropower potential. The hydropower potential is based on estimates from Schröder et al. At all points, or at points every 50 meters at every natural stream. And to calculate the hydropower potential of a municipality, we simply add up the potential at all points within its borders. So here are our main results. In panel A, you see the fixed effects estimates. And as you can see from these estimates, or these estimates suggest that the municipalities spend most of the water fee revenues and return nothing to citizens through lower taxes, though possibly through lower debt. In contrast, if we only use the predictable long-term variation captured by the water fee potential, a very different picture emerges. We no longer find a significant effect on expenditures, but now we find strong negative effects on taxes. The tax multiplier is interesting, as I said before, because of its high signal-to-noise ratio. However, the size of the coefficient is not informative. Municipalities of different size and prosperity will react very differently to a 1 franc increase in water fee revenues. Therefore, we also look at tax revenues. And here, the results suggest that a increase in water fee revenues by 1 franc, lower tax revenues by 1.28 francs. So overall, our IV estimates suggest that the local authorities return much of the water fee revenues to citizens through lower taxes. They also suggest that the large spending effect found in the simple fixed effects regression is an artifact of omitted variables or reverse causality. We do not interpret the net investment result because, as I said before, the net investment figures are very volatile and the result is not robust, as I will show in a second. So we run several robustness tests. Let me discuss 2 of them. First, if we drop the 10% most influential municipalities, the results are very similar to the baseline results with 2 exceptions. The first exception is the net investment result. So this result vanishes. And second, the tax revenue result becomes even more precise. In a second robustness test, we replace the municipality-specific time trends with municipality-specific period effects. Thank you. This change does affect our result. We now find large positive effects on current expenditures, current revenues, and negative effects on the tax multiplier. For 2 reasons, we think that including municipality-specific trends is the right thing to do. First, the results without municipality-specific trends would only be plausible with large multiplier effects, and we find no evidence of such multiplier effects in separate regressions for taxable income, taxable profits, and the population. And second, more important, in a subsample of municipalities without any water fee revenues, many of the municipality-specific time trends are significant. And given that our instrument has a clear upward trend, such trending confounders are a threat to identification in models without municipality-specific time trends. We have two validity tests. First, we run placebo regressions for the canton of Ticino. In this canton, all the municipalities, so placebo reduced form regression, sorry, for the canton of Ticino. In this canton, all the water fee revenues go to the canton, nothing to the municipalities. And reassuringly, in this canton, we find no effect of the water fee potential on local fiscal outcomes. This suggests that the water fee potential is unrelated to unobserved confounders. Second, we estimate a generalized event study for all the increases in the federal maximum rate during our sample period, and the results are very consistent with our main results. As you can see here, an increase in the water fee revenue lowers the tax multiplier and lowers tax revenues. Further, by the second year, the latest, all the effects have fully materialized, and we find no pre-increase differences for these two outcomes. Our instrument allows us to capture the predictable exogenous long-term variation in water fee revenues. However, our setting also allows us to simultaneously look at weather-induced short-term variation. In the interest of time, I do not discuss the corresponding results, but again, I'm happy to come back to that during the discussion. To conclude, we find that municipalities or local authorities pass much of the exogenous revenues to citizens through lower taxes. Our results for a setting with strong fiscal autonomy, strong participatory institutions, and with predictable exogenous long-term variation in revenues reveals no evidence for distortions in the political process. Therefore, the excessive spending effects found in other papers are possibly due to institutional aspects or agency problems rather than decision failures or the cost of taxation. In future research, it would be interesting to identify more precisely what elements help prevent excessive spending effects. We cannot do that in our setting because we don't have any institutional variation. Okay, thank you very much.
Okay, so thank you very much for inviting me. I'm Nicola Limodio from Bocconi University and CPR. I think it's an intriguing and very well-written paper, so I will commend the authors for that. There is a lot of very careful data work which was done. I think the identification strategy is interesting, even if used somehow in other settings. I think it makes a lot of sense. And it has a wide audience in political economy, in public economics, I think in finance and more. So, you know, it's the right paper for the right setting and the right audience that we are in, very diverse with different interests. So, you know, we are all going to be intrigued by this. And I want to thank the managing editors for inviting me to discuss this paper. It's always nice to be here, and it's an exciting time. I'll give you a quick summary and my discussion. My discussion will evolve around three very simple points that will mostly help the writing of the paper, but are conceptually important. First, about the main variable that is considered. Second, about the empirics and a bit some nitty-gritty that, while not being central, would really help a reader and the authors in shaping an impactful paper. This is a paper about Switzerland, and I had never read the paper about Switzerland. Was very nice. Switzerland is very interesting. It's a great lab for political economy. For instance, democracy at its most direct in Appenzell, which is, there are these, Appenzell is north of St. Gallen, if I am correct. There are monthly, bi-monthly, depend on the city, where the entire population meets and they discuss about topics and they vote by hand raise. I think it has a name length. I'm unable to pronounce it, but it happens. And so it's an interesting lab. People really meet and talk about public goods. I mean, something, along the lines of the models that we write. It's an interesting lab with a lot of limits. Appenzell was the last canton to give women the right to vote, only in the late 90s. So, it's really interesting, but, it's controversial. Now, the research question of the paper is whether the revenues, what happens when there are exogenous revenues, natural resources, and whether and how they affect fiscal policy. So the paper combines data on local public finances, 235 municipalities from the Canton Valais, 87 to 2015, and Grisons, 2000 to 2015, which are basically where this variation takes place. And they also build data for Canton Ticino, 2000, 2015. This is basically a placebo. These cantons are contiguous, but these are unaffected from hydropower shocks. And so this is a good placebo to show that it's not just some time series variation that they are picking up, and that's valuable. They exploit the institutional settings of hydropower revenues among municipalities. The cross-section is that different municipalities have different potential to produce hydropower. And so basically, that's the key cross-sectional variation. In the time series, what happens that the federal government puts a cap on the maximum tax that municipalities can apply to these hydropower revenues. So that combination is basically different municipalities have different potential, and that's what this picture says. The darker areas are areas that have a lot of hydropower potential, where basically a lot of energy could be produced, and that gives us the cross-section. And the time series is basically the maximum rate in francs per kilowatt that the government allows the municipalities to use. And I think that's a great, simple, clear identification strategy that they employ. The key findings, exogenous changes in hydropower revenues lead to lower municipal taxes on citizens. I mean, the authors kind of dismiss it, but a decline in net investment. The event studies picture on net investment is the best picture that you have. There are no pre-trends, and there is a clear decline. While the municipality, the tax multiplier variable, is a bit of pre-trends, and that's a very clear. Now I know that's not what you want to push in the paper, but I read the paper and I see this picture, and I see that there is a decline in net investment. Now, we need to be careful talking about the effects on other variables, because the fact that they're not statistically different from zero doesn't imply that they're not there. In fact, there is a lot of noise which tells us that municipalities use these revenues in very different ways. So there are no well-estimated zeros in the paper. There are a lot of large effects which are not statistically significant, sometimes borderline. So be upfront about that, and be upfront that you can well identify some effects, others not, most likely because you don't know the underlying processes that are driving this heterogeneity, which is fine. I mean, your paper can't be about anything related to this. There is a placebo with short-term fluctuations. A placebo with municipalities. I think this is a good placebo. The other, we can talk a bit about that. But let me give my main discussion. Key points. First of all, the main variable of study is the tax multiplier. When I read it, I was like, oh, wow. So this is a paper with VAR that combines micro-identification. I mean, very comprehensive. But no, the tax multiplier is the municipal surcharge on cantonal taxes. So For example, cantonal taxes are 100 and there are 119 in municipalities, so the overall is 229. Change the name of the variable. For economists, the tax multiplier is the ratio of the response of GDP to the initial tax shock. Blanchard Perotti, 2002, and Roberto is connected here. I think it's, again, I understand why you're calling it tax multiplier, but calling it tax surcharge is the appropriate term. Okay, you don't want to, remember, your readers, some will be very careful readers like me, some will not. And so you want to give them a clear, simple piece that does not make them confused. The second is about the scaling of this tax surcharge variable. The main effect that you identify precisely is minuscule, is something like 0.000643%. That's stable to SLS. Now, I understand that in the paper you say, well, this variable is statistically significant, but we talk about tax revenue. The problem is that tax revenue, the coefficients there are a bit more noisy than this variable. Now, so the logical issue is that you make inference on X1, but interpretation on X2. And that makes the paper a bit hard to read, in my opinion. Why don't you try to change the variable? For instance, I would change the scaling of this variable. You can take, so this is a share. Why not calculate the average surcharge and take the log? For example, you can take the average GDP per capita, and you can take, basically, you can apply the share to this level, and then taking the log of this, I would. Or, you have taxable income at local level. So you can come up with a different scaling of this variable that makes the coefficient interpretable. Because that's what I see. I mean, I'm not worried about the number. Of course, we all know that it's a late, and there are fixed effects. I mean, and so, but can you find a scaling that makes it clearer and interpretable in a convenient manner for a reader and for you? I think, you can use, there are different ways in which you can do it. I encourage you to use a couple. Maybe you tried already a few, and, I think that can be improved. Then, passionate advice, always write down the equation you estimate. Because I couldn't find in the paper the equation for table 2, for table 3, for table 4. I think the equation is this one, basically where you're estimating some variables for municipality M in canton C at time T on the fee that is going to be applied. Well, it's municipality M at canton T with municipality canton time fixed effect, and then municipality time trends, and then controls. I think this is, here it's M, so I made a mistake. So there are controls, taxable income, population, age groups, foreigners, and so on. Sometimes less is more. You are loading this equation with a lot of stuff. I like table A1, there are no controls. I would also remove the canton time fixed effect. I mean, I understand that throwing in a lot of controls and fixed effects gives you possibly cleaner variation, but it also removes a lot of variation that's the good variation that is used. For instance, from the cross-sectional picture, we see that there are clusters of municipalities that are close and have similar potential. So, you're removing a lot of that as well. I mean, I am generally, especially the controls. I mean, some of these are bound to be bad controls, like foreigners. Many my friends live in Zurich, and they live in other municipalities because the surcharges are lower. So there is, I'm not sure you want to keep all these controls. They can be bad. They can affect negatively your estimation. And then a little bit of nitty-gritty. I am by training a development economist, a bit all over the place with interest in macro and finance. So, but I would have expected to see a paragraph talking about, the external validity of your results and the fact that Switzerland is an advanced economy, is a very unique advanced economy because it has very established revenue sharing rules and democracy that is, that has started a few centuries back. I would discuss this talking about this, why this is a special setting as a pro, but also as, clearly putting it in context in terms of generality of the results. And what is more important is about the incremental variation. So especially in the introduction, you seem to refer a bit about the fact that, how governments spend additional resources, but this is not about the discovery of resources. It's really about small changes over a small period of time. And so be upfront about that these incremental changes are interesting, and these are the ones that you're capturing. For the literature, I think you do a very good job of keeping your paper very focused to the literature in public economics. I think given the outlet that you are considering, you can be a bit broader, because shorten and focus the current discussion on public economics. Some of these results are old, some of these results are badly identified, as you point out. You can make a tighter, clearer, simpler contribution of where your paper advances the literature that is out there. I think you can add a bit of, on cohesive institution, these Basel-Pearson arguments, the part on external validity. But the paper also speaks to other literatures. For instance, one on municipal finance. And you can see the work of Kimberly Cornaggia, Tane Babina, and others. They tend to look at bonds and how municipalities change their behavior when, on the debt side, there are changes, while you have a change in tax in revenues. But I think your paper, could speak to those and give a cleaner, neater, well-identified study to a literature that is, a bit, I think, a notch below in terms of empirical standard. And, there is a literature on the effects of commodities, and I have also some work on that. So what is interesting is that your paper looks at typically the literature on commodities studies something like gold or silver or oil or, a bunch of traded commodities, while you're looking at a commodity that is non-traded, that is water. And I thought your paper can give insights to this literature as well. I found it interesting for this respect. One thing that I would ask you to do, you write federal politics gradually raised the maximum rate. That's basically the time series variation. I would have a little paragraph, I would add a couple of paragraphs. This is basically your key source of time series variation. You talk about inner workings of the parliament, that this is anticipated, unanticipated, municipalities know, don't know. Write it carefully in a way that makes the paper clearer and assists the reader in understanding your paper. Yeah, that's I can skip that. Yeah, again, these are very tiny. I have a couple of seconds. So I think, this paper offers novel evidence on how natural resources shape local public finance, and is interesting. Interesting topic, careful and valuable data collection, and the identification strategy is neat, is clear. I would present it in an essential setting, as you've done, and you can improve and make it even simpler. What do we learn? We learned that hydro revenues are split in Switzerland. The higher hydro revenues push down taxes and maybe investment. Seems to be the case. Can we learn more? Maybe for the future, not for this paper. What do higher revenues before elections lead to special effects? This is kind of a more, standard, fully fledged political economy paper. It's not this paper, but maybe it's something that is ahead. And, look at countries like Brazil. We could learn something about this. So thank you very much for having me, and congratulations to the authors for this interesting paper.
Hi. So I'm very glad to discuss this paper. I think Simon did a great job in putting the setting, and Nicole as well. So this is a bit repetitive, but the central question is how the local authorities use windfall revenues or exogenous revenues for which they cannot influence. There is a large literature looking at how grant money and conditional grants will affect local, how local spending or how grants will actually be spent, because, and this is relevant because it's important to design, for the design of intra-governmental transfer policies. And as Simon said, the prediction of the theory is that as long as the government reflects, government spending reflects voter preferences and voters are rational, meaning that they perceive grants and income as being basically exactly the same, and they do not have a loss aversion, then basically unconditional grants will crowd out public spending, and they are equivalent to a lump sum tax reduction for citizens. But there's a huge empirical literature showing that this is not the case. That this prediction fails in many settings, and this is the so-called flypaper effect. Overall, the evidence is mixed, and the three main explanations for why we find this anomaly is basically has to do with identification of the effect, but we do not really capture exogenous variation in these windfall payments. And then whenever these two assumptions fail, that basically politicians have an own agenda and other incentives, and that the political system and institutions do not allow us to penalize those behaviors, or that voters are not rational. For example, if they are loss averse, then the political cost of increasing taxes is greater than the political benefit of lowering taxes in the same way. So that would explain why governments would use grant money to finance expenditure, because they do not need to raise taxes for that. In this paper, the nice thing is we can cross off the identification problem. They use exogenous variation, exogenous time varying variation on this maximal water fee set at the federal level, and they discuss very credibly that municipalities cannot lobby for increases there, and they combine this with cross-sectional variations on the potential, hydropower potential of the municipalities, and so they can instrument municipal water fee revenues and see what the effect is of this exogenous part of these revenues on different fiscal outcomes. And in this setting, they argue we have very strong fiscal autonomy, direct voter participation, and strong institutions. So that would make us not be concerned with the assumption about the political system failing. So if we would find a flypaper effect, then that would mean there are behavioral explanations behind that. They find that an increase in water fee revenues has no significant effect on expenditures once we deal with the identification issues via a valid instrument, and then find significantly negative effect on the tax rate surcharge, tax revenues, and net investment. So they argue, as in a paper by Lutz 2010, that the institutional aspects are probably behind the flypaper effect found in other settings rather than behavioral explanations. So I have to say, this is a very well-written paper. There's much to praise. They made a very clear exposition of the institutional setting, and they have a rigorous empirical analysis. When you read the paper, you notice that this paper has gone through a thorough revision process. They have many robustness checks, and they have a very good, so they are very careful about what they can infer from their different estimates and what cannot be inferred from that. So I really liked that. The data documentation is excellent. This is the slide where you would say, well, so much for the praise, but to be honest, I do not have much to criticize. I think that with the data at hand, they do a good job at identifying the effect that they are after. So my comments are more on how to boost the impact of the paper in terms of citations. I think that you are very narrow in how you frame your contribution. Yes. So, and I think that I wonder whether you could do more than just provide evidence on the paper effect in a setting with strong fiscal autonomy and participatory institutions. Yes, which is very close to that paper of Lutz and Riester, I think. And I think you can do that by, that this is something that Nicola also pointed to, by broadening the literature you speak to. And I was more thinking about speaking in general of the effects of natural resources on public finance outcomes. And what came to my mind is there are some recent papers on the Alaska Permanent Fund Dividend, a very recent AEJ poll by Jones and Marinescu, where they actually look at whether this permanent fund dividend, which is capitalized by revenues from publicly owned oil production, basically each citizen gets like a cash transfer. In that paper, they look at labor market outcomes, but still it's about the impact of this or how money from natural resources is transferred to the citizens and what effects we might find there. And there is an older paper, which I found interesting because it argues that that Alaskan citizens perceive these cash transfers as an entitlement that all inhabitants have because it's a commonly owned resource, so to say, rather than public spending. And then I think that maybe you could hint at implications of the findings you have in the wake of the proposal to reform the water fee system in Switzerland. I read that they were thinking about changing these fixed rates to flexible rates, and this will have interesting effects because, as I understood, then the distribution of, so it would be more tied to the profits of the companies, and this the owners of the companies typically do not live in the municipalities where they operate. So there's an interesting discussion there, and also in the wake of rising electricity energy prices in general, and also other things that would be nice to look at. I know that there's some data that you cannot, produce out of thin air, but in the start of the paper, you start with an intriguing this anecdotal evidence that different municipalities do different things with these funds. And you say that report on some municipalities give away consumption vouchers or subsidize health insurance, and others finance local infrastructure. So I was wondering whether you could look at heterogeneous effects across municipalities. So along your observed X variables, and then maybe more descriptively unpack what's absorbed by these municipality fixed effects. In your figure 2, I think, where you see the distribution of the water fee revenues, this is a very, very skewed distribution. So I was wondering, how are the time variant and time invariant characteristics of these different municipalities? How do they look like? Maybe just above and below median? Are we talking about completely different municipalities, or maybe there's something interesting there? I don't know, just to give the reader a little bit more. And another thing that I thought about is whether beyond this strong institutional story, whether there's something in these municipalities that has to do with the perception of property rights over natural resources. Yes, my husband comes from a very tiny village in the German Alps, and there, and in Switzerland it's the same, there's a common ownership of the alpine pastures. Yes, and it's very interesting because in that case, in that village, the property rights to these natural resources are tied to the property of the oldest houses in town. And these rights are inherited in the family. If you come from abroad and buy a house, that's not going to happen. So it's really the old families that get to use the resources and decide what will happen with the revenues from that resources. And there's like, since the Middle Ages, this tradition of this common property, basically in all regions. So for example, in Valles, they are called the Alpgeteilschaften, but in the Ticino, you also have, I think, Spatriziati. So I know that maybe you cannot do something with that, but I was wondering really, what if revenues perceived as earnings from a commonly owned assets, and does that play a role beyond, well, we have direct voter participation and institutions? And this is the argument made in this one older paper about the Alaska Permanent Dividend Fund. But basically, that's it.
Go for it. Tell us who you are.
Hey, I'm Emric Henry from Sciences Po. So the question is about, is this too much? So it's a very interesting setting, very interesting empirical results. What I'm missing a bit is a guide to what I should have expected initially. And so the discussion talked a bit about it, but here there's 2 points that bother me a bit. One is it's a municipal tax that interacts a lot with the other taxes. So in particular, the canton level tax. So you're going to have necessarily a reaction to how these taxes are set, and you're going to react to how they are set. So you're not completely free from constraints. And so understanding what we should expect is quite difficult. The second is the point that was made by Nicola, is that investment jumps at you on the graphs. Why would we have a drop in investment? Is it because it's actually not a short-term shock, this thing, but something that's expected to be a longer term? So we see that these fees keep rising. So do we actually expect that they're going to keep rising? Yeah, I was missing a bit the guide to what I should expect and it helping me interpret the results, but it's a very interesting setting and interesting empirical results.
So I have one question rather than a comment, and it's about the way that the Swedes, the direct democracy in Switzerland is perceived by the people there, and also kind of by the international observers as well. So the direct democracy is not unique to this country in the sense that, for example, in the US, half of the states have various kinds of ballot measures like initiatives and referenda, etc. And in the case of the US states, there do not seem to be all that much of sort of confidence and trust in that institution because it's so tainted by special interest politics. So there's a lot of money going in from the lobbying groups and trade associations getting into these ballot measure voting processes. And so there's has been social science documentation of the influence of this special interest politics money in the process. And there has also been a lot of documentation, like efforts for the documentation of like voters' ignorance about the actual policy that's being discussed, etc. So my question is, when you compare direct democracy in Swiss with the cases of other countries, how would you evaluate the institution in terms of the actual incorporation, like voter knowledge of the voters about the actual policy, the turnout, and the extent to which the voters' preferences are really sort of generally reflected as opposed to special interest politics, special interest influence, etc. So that's my question. And probably that also affects the evaluation of the external validity of what you learn from this context to other context, more general context.
Yep, so I'm Katarina Nordblom from Gothenburg. So I found this really interesting, and I haven't read the paper, so perhaps it's in there, but I was very curious about also the time dimension, and when it comes to expectations on future future rules and so on, because I mean, you said that this cap is always increasing, and is that also an expectation from the municipalities? Because I mean, you find that you have an effect on the tax rate rather than expenditure, although investments also decrease, which, as you pointed out, that perhaps this is something that the municipalities count on being for long term, that, okay, we can reduce the tax rate because we think that this will go on for a longer time. Whether if you think that it's short term and soon you will lower the cap, then perhaps you would have to raise tax rates, which, I mean, that's not very easy politically. So what about this time dimension and expectations?
Okay, I was wondering to what extent you have some heterogeneous effect according to the political orientation of these municipalities and also their financial situations. And more broadly, could you tell us whether the region you are looking at are more left-wing, right-wing, or whether their financial situations overall?
Okay, thank you very much. Thank you very much, Nicola and Valeria, for the excellent discussion. And also thank you very much for all the comments and questions. Switzerland may be a special setting. I think the more important question, is it unique? And I think it is not. There are many other countries that have strong fiscal, where you have local municipalities with strong fiscal autonomy and participatory institutions, as you have mentioned, especially in the US, but also in other countries. So I think it's a special setting, but it's not unique. And therefore we can apply the results also to other settings. Then why do we not focusing on the net investment results? I think the main reason is that these results are not robust, as we show. So these results clearly vanish once we drop the most influential municipalities. And this is the reason why we do not focus on these results. Then the tax multiplier, yes, thank you very much for the hint with regarding to the naming. That's indeed unfortunate. This was a literal translation of the German word for this variable. Different scaling, I think this is a bit more difficult because, as I pointed out in the presentation, we cannot simply scale it by the tax revenues or the taxable income because an effect in the water fee increase will have very different or municipalities with a different prosperity, different size will react very differently to this given increase in the water fee revenue. So there we definitely have a lot of heterogeneity across municipalities. We would expect a lot of heterogeneity, and I think that therefore we cannot simply scale it. We really only use this variable as a signal detection device because it directly captures political decisions. Then with regard to the controls, I agree, we don't need these controls. We drop the time invariant controls in the time varying controls in an appendix table. We include them in the main table in keeping with the previous literature, but we could also exclude them. The canton specific time effects, they are there because two referees wanted them. So I'm agnostic about, we can also drop them again. This is something that is there because of the referees. Broaden the literature review, that's a point that has been raised by Nicola and Valeria. I think we should definitely look at how our contribution fits into these additional literature. So the literature on municipal finance and commodities and on natural resource revenues. And I'm not so sure whether we should talk about the reforms of the water fee revenue system in Switzerland. I would like to do this. I don't know whether this is of interest to an international audience, but maybe we can add something to that. But I think it's definitely a very interesting question, what is going on there. Heterogeneity with regard to different aspects. We looked into this. We also plan to or try to use a matching procedure. And one of the difficulties was that it was very difficult to explain whether municipalities had low or high water fee revenue. So the variables that we have do not allow us to predict very well the level of water fee revenues. So no, that's not with regard to heterogeneity, excuse me, this is with regard to whether Valeria's point, whether municipalities with high or low water fee revenues differ. So with regard to heterogeneity of effects, we looked at effect heterogeneity with regard to the financial condition. So especially debt levels, and there is not much there. So there is not much heterogeneity there. What else? Guide to what is to be expected. I agree that the municipal surcharge, so municipalities might change their tax multiplier in reaction to what happens at the cantonal level. But I think it's important to point out that this a change at the cantonal level affects all municipalities equally, and therefore such changes at the cantonal level should be absorbed by the canton specific time effects. But still, I agree we could do more about in explaining what we would expect there. With regard to direct democracy, I think broadly it's very accepted in Switzerland, and it's less of a discussion about special interest group capture. Of course, this is also a discussion, but I think it's mostly, I don't think it's a large discussion at the local level. So these are two mountain cantons. Most of the municipalities are rather small, and therefore I think there are not a lot of interest groups, or at least not organized interest groups. Maybe there are special interests, but less organized ones influencing these decisions. Then with regard to what should we expect, or what do municipalities expect with regard to the water fee revenues? Are they always increasing? So far, they have been always increasing since they have been instituted since the early 20th century. But there was, as Valeria pointed out, a recent discussion whether we should change the system, and this would have, so it could be that they are reduced in the future. So I think here expectations may change, yes. But thanks again to all these questions and comments.
Okay, it's time to start again. So the next paper is by Katarina about the legacy of COVID-19 in education. So Katarina, the floor is yours for 20 minutes.
Perfect. Thank you so much. Thank you for being here for my presentation, which is joint work with Ludger Wössmann, who's also at the IFU Institute. And what we wanted to do with this paper is provide some evidence from surveys that we ran on the situation in the education system during the pandemic and the subsequent school closures in Germany, which will be the context that we're looking at, and then also kind of make sense of that in light of the emerging literature that we have on this question. So what I want to show you today is, first of all, talk a little bit about the surveys that we ran in 2020 and 2021, talk about the data. And then I want to run through 3 sets of inputs that we might think are important in creating learning in students. So as education economists, we like to think of learning as something that requires a number of factors to be in place. And we thought it was helpful to group them into different sets of inputs that are necessary actually for learning. And of course, all of these were significantly impacted by the school closures that countries introduced in order to mitigate the spread of the virus. And then lastly for today, I want to talk also about children's socio-emotional development, because there were a lot of concerns emerging that one of the unintended consequences of having school closures was actually a negative effect of this forced isolation, which was so instrumental in kind of stemming the spread of the virus on children in particular. In the paper, we also talk a little bit more about cognitive development, so the test score outcomes that children have before and after the pandemic. And there's also a literature that now tries to estimate how these losses that we see in the education system in the short run, which is what I'll be talking about today, how we can kind of assume that those would be translated to longer term outcomes and inequalities later on. And then there's also some scope for policy conclusions that we can draw from this work. But let me get started by talking about the data that we have and the methodology that we're going to use. So we rely on online surveys. So we have online access panels that allow us to have access to parents of school-aged children. And one of the things that these online access panels allow us to do is to select participants that correspond to a very broad fraction of the population. So we can make sure that the people that we survey are kind of representative in terms of observable characteristics. So for example, age or gender, also employment status, education status, the region where they live. So kind of in a way, this is quite a nice way to get a broad representation of people that are affected. And as I said, for us, the German context was the one that we're interested in. And we basically were able to run 2 surveys. So the first one was actually in the spring of 2020. And here we had a general population survey. And out of those, in the general population, we were able to survey 1,099 parents of school-aged children. And then we were able to run a second survey about a year later, basically because the pandemic showed no signs of abating. Unfortunately, even in the second consecutive academic year, we decided to run a second survey. And for that one, we just focused on parents from the onset, and we were able to survey 2,045 parents. One of the really nice features of this is that we were able to recontact a significant portions of the parents that we surveyed in the first 2020 survey. So we can actually look at the changes over time for 513 of these children. What that allows us to do is actually not only look at cross-sectional evidence. So for example, if you think that maybe you would observe differences between certain groups in society, in a cross-section, it's very hard to know whether these would be caused by the pandemic or kind of have been there all along. So this panel dimension really allows us to shed new light on how families, schools, and children adapted over the course of the pandemic. Now, it's also important to note that there's no reason to assume that this would be a completely random sample of the people that we are able to recontact. And in fact, if we look at the characteristics of the panelists, they look broadly similar, but we can tell that they're a little bit more educated on average, they have higher incomes, and their children tend to attend kind of like more academically challenging tracks. We are less worried about this than we would otherwise be, because what it actually turns out is that we find very similar results if we look at our longitudinal evidence and our cross-sectional evidence. So in that sense, this kind of longitudinal component is really important and helpful for us to actually put into perspective the differences that we see in the cross-sections. The second thing that we were able to do in our survey is compared to, and this is kind of especially true for the second survey, we were able to expand the list of questions that we had on possible consequences of the pandemic. Because what I think it turned out is, as the pandemic went on, that there is influence of the school closures on a variety of factors. And actually, we were able to include much more nuanced measures on skill domains, including socio-emotional well-being, so the SDQ scale for those familiar, also psychological burden, social skills, which allow us to paint a much more kind of nuanced picture of the consequences of the school closures on the development of children. Okay, now let me show you some data that we have, and I'm going to go through in the order of looking at child inputs first, then parental inputs, and then school inputs. The first thing I want to show you is basically evidence from a time use battery that we had. So these are parental reports of how much time on average that children spend in different activities. Now we elicit the kind of time that children spent in particular activities before the COVID pandemic retrospectively, so that's important to keep in mind. But what we see is that the time that students or children spend on school-related activities was basically cut in half in the first year of the pandemic. Now, looking at our second survey in early 2021, we see that this recovered slightly, but not very much in the second year of the pandemic, which means that in spring 2020, we had a very radical shock where all of a sudden children were spending much less time on school-related activities. And then we did see an increase in this time of kind of in the second consecutive year of the pandemic, but we are very far from a scenario where this kind of time investment that was normal previous to the pandemic was recuperated. Of course, looking just at the time that students spend in certain activities comes with a lot of caveats. One of the most important ones is that we don't really know what exactly students do in this time that they spend. So in the absence of kind of having more reliable tests where we could actually look at students' achievements in particular domains, the closest we could get is to basically ask parents to assess the effectiveness of their children's learning. So now this is, of course, comes with some caveats where you might think that parents might make some mistakes in assessing this effectiveness, but we still think that the pattern of results is really interesting. And what you actually see is that more than half of parents, so everything that's in the red here, would agree that, or would state that learning, each hour of time that children spend learning for school is less effective at home than it would be at school. At the same time, it's true that there is a non-negligible share of students, almost a quarter, where parents say actually each hour they spend learning at home is more effective. So this already hints at something that's been discussed a lot in the wake of the school closures and COVID, where people have been extremely worried about the potential effects on the inequality in learning that might take place when students are basically sent at home. There is this notion in education economics that schools are the great equalizer in a way, where basically sending your child to school will give everybody a level playing field. Now we can imagine that if we kind of reduce the structure, if we take away the trained educator from children's environment, we might see the emergence of much larger gaps between how well individual students are actually able to learn kind of on their own. And this is actually corroborated in our data. So what we do here is we split our sample between the students who prior to the pandemic were basically on track in their grades. So they were achieving school grades that were at or above the median for their school type. And then those students that were kind of below the median grades. And what we see is that the share of parents that report that actually learning at home is much less effective is significantly higher for those students that were kind of struggling to keep up with school prior to the pandemic. We have a very similar picture if we split the sample instead of parental background. We know that this correlates very highly with children's education success in the context of education of Germany. So these kind of taken together with the kind of time use evidence I've just shown you, these kind of measures again paint a picture where the time investment dropped significantly, but then also we might have some worries about the effectiveness of the time that was spent on education. I'm going to be very fast here. This is basically just further evidence that shows that even if we look at more individual items on whether children were concentrated, whether parents say they were well organized in their learning at home, we see a very different pattern. The importance of this reduction in time that students spend learning for school really depends on what else they did with this new kind of time. And so the purpose of this exercise was basically to try and see where this kind of time went instead of learning for school. And what we find here is that actually the largest increases seem to be in categories that parents think are rather detrimental for child development, which are the ones that we kind of depicted in the orange color down here. So it does not seem to be the case that this time that was lost or no longer spent learning for school was actually put to uses that as education economists we would think are very productive in learning. Now, I just want to show you this one table on the role of parents. And I think this makes a very striking point, which is if you compare the number in the first column, so the time that parents spent with learning with their children before the pandemic, to the numbers in columns 2 and 3, we actually see that parents significantly increased their efforts in supporting their kids' learning. So they more than doubled the time that they actually spent with their kids on learning. However, this still kind of creates an environment where children have much less input overall. And also what we see is that there are slight differences where students with higher achieving students would have more support from their parents on average, just about. But we don't see that parents are able to compensate very effectively for differences. Now, lastly, I want to talk about schools, because of course, just because the schools were closed, that kind of refers to the physical school. It does not refer to the fact that schools were all of a sudden no longer supposed to teach students. What we see in the German context is that a lot of schools initially struggled to engage with students very directly. So in the first survey 2020, only 7% of parents say that the child actually had at least once a day some sort of synchronous learning experience where the teacher was talking to the entire class at the same time. This was not really kind of compensated by with individual conversations between the teacher and the child. So if we look at the second set of bars, these kind of numbers remained rather low. Instead, what it turns out is that most schools were providing worksheets to students in order to allow them to work through material kind of on their own. So we have very high shares of parents reporting that the child was required to complete assignments. Only a fraction of those, however, actually report that they received feedback on these completed assignments, which usually you would expect as an important prerequisite for learning to take place, is to also receive feedback. If we compare the 2020 survey to the 2021 survey, especially if you look just at the first bar where it's about the joint lessons, we actually see that schools really expand their reach in this area. So in a year later, basically 25% parents say that their child had at least once a day, there is a joint lesson where the teacher is talking to all of the students, for example, by a video call. At the same time, even kind of in the second year of the pandemic, a third of parents still reports that their child would see or speak to the teacher in this manner at most once per week. So again, we see kind of large heterogeneity, but we do see a large increase in the effort or the success that schools had in reaching students and providing some teaching. One of the things that our panel structure allows us to do is to actually see whether we can find out which of the school's activities correlated to increases in the learning time of students. I want to be very brief here, but what we see is that in columns 3, 4 and 5, we basically add the learning time that someone spent in our first survey, so in the first year of the pandemic, as a control variable to a specification that predicts the learning time in the second period, which means that allows us to basically take out all of the unobserved factors that might be determining the learning time and that are constant across the 2 years. And if we look at the specification, we see a really interesting patterns where out of all of the different activities of the schools that we look at, it's actually only the joint lessons, so only this kind of synchronous learning experience that correlates significantly with an increase in the time that students spend learning. And if we kind of look at that more closely, we actually find an interesting nonlinearity, if you want. So if we include the different categories of frequencies, which might be more intuitive given that this is not really a sensible linear scale, we actually find that it seems to be like a daily synchronous learning experience that really seems to be driving increases in learning time in the second year of the pandemic in our data. Now, I want to talk a little bit more about children's socio-emotional development, because I think one of the factors that has kind of emerged through the course of the pandemic is that children and families were hit quite hard by a lot of the kind of isolation and school closure measures that were taken. And the first thing I want to show you is a question that's a very simple, very coarse measure, if you want, of these effects. And it's the question of whether the parents agree that the pandemic or the school closures were a great psychological burden for the child. We see that this is already high, so more than a third of parents would agree to this in the first year of the school closures. We also see that it increases significantly in the second year of the school closures. So this runs somewhat kind of counter the evidence I've shown you so far, because we saw that for the learning time and for the activities of the schools, we kind of saw a very dramatic situation in 2020 that kind of slowly started improving by our second survey year. So this is not what we see in this picture. Instead, what we see is maybe some sort of tiring effect where actually the perceived psychological burden of the pandemic increased over time. And this is very closely mirrored by whether the parents say that they think the pandemic was a great psychological burden to themselves, and then also to kind of a very broad measure of conflict within families. Now, I want to spend my kind of last couple minutes talking a little bit about this, so bear with me as I talk you through what you can see here. These are the results that we have for the SDQ, which is a widely used scale to judge socio-emotional well-being of children. And what you see very up top is an overall index that just shows you the general change across all of these items that we have. And then below that, we have individual categories. So we have emotional problems, conduct problems, peer problems, hyperactivity, and pro-social behavior. And for all of these, the first line is again going to give you an overview, and then we have the individual subcategories. Overall, in this entire graph, we always have blue denoting basically improvements or positive statements, and red kind of denoting deteriorations or negative statements. So if we look at this now, what we see is actually the gray bars seem to be the highest share for all of these items. The gray bars mean that the parents say a certain statement applies the same to their child regardless of the school closures, which means that parents actually, a large share of parents for each of these items. So for example, is my child often unhappy, depressed, or tearful? The large share of parents, so 45%, would say this is the same before and after the school closure, so no change. However, we also have large fractions on both ends that report both improvements and deteriorations in these results. So if you look at the emotional problems in particular, we see that there's a lot of blue and red on both sides of these scales, which says that for some children, things got worse, for some it got better, and we have a lot of heterogeneity here. Two things I want to mention in particular, where that might be very interesting, is we have two items that are very related to bullying. And there has been some literature that actually talks about the effect that school closures might have on bullying in particular. And actually we see that in these two items, we see large improvements that basically do not have a matching deterioration for other students. So there's a kind of much more improvement in the agreement with the statement whether the child is often fighting with others or bullies them. And it's also an improvement in whether the child is being picked on and bullied by other youth. So this actually shows that for those children who might have problems with this sort of behavioral issues in school prior, school closures provided some positive side effects. On the flip side, what we see is actually deteriorations, particularly related to hyperactivity, where parents are more concerned about their child being easily distracted, or also kind of not having a very good attention span. So this seems to be an area where actually much more parents see a deterioration in their child rather than an improvement. So overall, we see that parents of high achieving students are much more positive. They are more likely to report improvements in any of these measures. And interestingly, we don't have the parallelism by the education background of the parents necessarily. So we see kind of smaller differences in that regard. Let me conclude. So overall, we show that students' time use and educational inputs changed over the time of the pandemic with a little bit of bounce back in terms of time use and school, the activities of schools. We also see very mixed results for the socio-emotional development of children, where we have large fractions of kids that are negatively affected. We see some more positive upsides. And overall, we think that remediation is going to be really important going forward in order to make sure that these don't create lasting legacy of school closures in human capital. Thank you.
Thank you very much. This is a paper discussed by
Let me first thank the managing editors for the invitation to joining this economic policy panel. It's great to be here. And I'm very happy to discuss the paper on the legacy of COVID in education. Oops, no, I can see the right one here, but it's not showing. Thank you. Exactly. Yes. Thanks for the opportunity to reading this interesting and very policy relevant and timely paper. So the authors aim to address the following questions. First of all, how did children's and parents' time use respond to the different, to the repeated school closures during the crisis? And ultimately, kind of how did this affect both kind of socio-emotional skills, well-being, and also the authors look at a number of kind of academic skills, which I think we didn't see today. One very important aspect is also how do results differ in terms of SAS, so in particular in terms of parental education and prior academic achievements. And you know, the authors conclude with kind of an outlook of, given the results they have in the short run, given the existing literature, what might we expect kind of in terms of long-term economic implications? The two kind of key contributions that the authors aim at is first of all having this kind of longitudinal component to the survey. So they have two surveys in the two different kind of two times of school closure, which also contain a panel component, so they can actually follow some people over time. And the other contribution they mentioned is having a very interesting and rich set of socio-emotional skills. And just very briefly, we've just seen it, but the kind of three key results to take away are that children's learning time decreased really severely and particularly strongly for low achieving students. In the second round of school closure, there was some mediation, so the learning time increased slightly because of a larger number of schools having daily online lessons, but the increase is in fact, unfortunately, relatively small. Now, we've seen an interesting slide on parental assessments of the effectiveness of children learning at home. You've mentioned that, so my reading is a little bit different, and I will get back to that in a minute. And ultimately, there's an interesting set of results in terms of children's socio-emotional developments. You mentioned they are mixed, and in fact, there are a couple of categories where we even see positive effects, which I think is, raises some question also, why is that? Who is actually, less negatively affected? And I think these are really super interesting and important aspects. And I will focus so mostly on time use, effectiveness of time use, and then the socio-emotional development of kids. You mentioned already that the time use measures are in part retrospective to before COVID. That's, of course, has the usual caveats. I think one observation that I made, that I think the referees made as well, was that there's this big loss in hours spent learning, but there's only a relatively small increase in other activities, right? So where you have these two classes, kind of, more high qualitative activities like music, reading, sports, and then on the other hand, this kind of more detrimental activities like TV, gaming, etc. So of course they don't capture everything, but I think one reason why this kind of big drop in learning is not made up by these other activities is, I think, in part that there's kind of an overestimation of the activities in the first round before COVID. And I think that's something that is useful to discuss a little bit more in the paper, because then this also solves a little bit this mystery why, what are kids doing instead? I think part of this is really like an overestimation. If you add this up, and you're not including sleep, personal hygiene, commuting, then I think, there must be some slight overestimation before COVID. And so that might explain part of what's going on. I think a more, a point which content-wide is also important is that, is this question, what did people do instead? And I think one category that unfortunately, we don't have evidence here is what happened to, for example, sleep time, what happens to time, for meals spent together as a family. And just anecdotally, I think there's, some, we might think that probably these things have gone up. And I think that's relevant because it might actually help to explain also some of the, less negative or some of the positive effects that you find that, we did have a change, which at least in part, had some positive aspects, like kids, getting more sleep, spending more time with families, having meals, etc. And so, I think it's useful to discuss that because it might help you explain some of the other findings that you have. A second point is on the effectiveness of learning. And I think, so the way I was reading it is that if you look at who believes learning at home is at least as effective as in school, so either equally effective or more effective, you have actually 44% of parents overall that think that, and a majority of academic parents, which I found very shocking. Okay. One qualification might be, and maybe that's worthwhile to discuss a little bit, is that parents are thinking mostly in terms of kind of, academic skills that kids are learning, cognitive skills. And, maybe if you take into account social skills, the assessment would not be as negative. But I think even, with this qualification, I think a more general, point one might be worried, one has to take away from this is that, what's going on with the German educational system, that, you know, such a large fraction of parents think learning at home is actually as good or maybe even more effective than at school. So I think that's something important. Maybe a positive interpretation of this is that, well, maybe it's good that, you know, we have these households where kids can learn well from home. So in other countries, it's more the case that, you know, that homeschooling is an option, like Austria, Italy, in US, it's quite important. You know, just a provocative thought, maybe that's, you know, one way, you know, possibly it could be one way to kind of address this big problem coming up in the future of like shortages of qualified teachers. In any case, I think for you, it could be kind of the start of an interesting research agenda, that you have this sort of more general, you know, conclusion from what you're doing, comparing kind of this learning at home to learning at school. I think that could be interesting to explore this a little bit more. One point that refers particularly to this parental time investment is, I think you're showing us averages across all ages of children. And I think that's particularly relevant here for looking at parental time, that, you know, how much time parents spend helping kids, you know, to read, to do homework, etc., is completely different for elementary school kids than older kids. And so here, I think it really is important to kind of split this up. And in fact, I think it's relevant more generally, because in elementary school, right, you learn all these basic skills, reading, writing, studying independently, which you kind of need as a precondition to do remote learning, kind of, you know, for remote learning to be effective. And so I think these are very different groups you should, you know, you need to kind of look at separately. And also parental time investment. I think you mentioned some things in which it differs between low and high achieving children, but I think that also deserves, you know, this inequality aspect is so important, as you mentioned. I think it deserves more focus, you know, in your paper, and showing a bit more results on that. One last point on this. I think you use a little bit too little kind of connecting different parts of the paper. So for example, it would be interesting to connect kind of how much parents spend time with the kids to how well the kids are doing. Maybe it's the kids, you know, who do relatively well because, you know, not because, but at least there's a correlation between, you know, how well kids do and how much time parents spend with the kids. So I think there you can do a little bit more. It's of course descriptive, right? It's correlation, but I think it still would be very important. And also the panel dimension, you mentioned it. I think it's, you know, it could be a very important contribution. I think you're not using it as much as you could, where maybe you see parents who perceive the effects as particularly negative, maybe they are the ones who take more time off to make up for this kind of negative shock. I think that would be really exciting to do. One point, you link the students' overall learning time to parental inputs and school activities. What I think you haven't shown is whether school activities and parental time are kind of substitutes or complements. And I think that's something, you know, putting this into action would be really interesting if parents, you know, spend more time with the kids, if, you know, or in the case that the kids have little online learning, or whether this is kind of, you know, complementing. I assume it's probably substituting, but it would be interesting to see. And also how this differs by parental background. Okay, so if maybe high educated parents are more able to kind of to realize, okay, there's less going on in school, and they're able to substitute for this with this home environment. And just the last point, so socio-emotional development, that's the other kind of very big, you know, focus of the paper. Very interesting, this figure where you show kind of how these different types of groups of skills like emotional conduct, peer problems, and also hyperactivity, how they are affected. I think that's super interesting. But here, I think, again, you could do a little bit more kind of linking it also to these other activities. And one way, kind of a practical point, I think, you know, you have a lot of results. It's a very long paper. One way you can compactify this a little bit is not to show every single question, but just really show the categories, like, you know, here in this case, emotional problems, you know, peer problems, etc. Just show the categories, and then you can do much more in terms of really showing, you know, heterogeneity effects as well, which I think would be extremely interesting. Okay, and so doing a little bit more here, shortening is instead a little bit more the literature discussion. You mentioned it was supposed to be a bit of a survey, but I think, you have enough and exciting own results that you can, shorten kind of the discussion of the other literature a little bit more and really put more focus on your own work, which is basically what I want to conclude with also, very important findings, relevant to the COVID crisis, to school closures, but I think even more generally, so that's something I would also make use of, important insights for policy recommendations, but what you can do is you can, push, I think, your data even more, use the strength of the data that you have. And again, it will only be correlational, of course, but, I think also in descriptive sense, you can show even more exciting and, exciting results that we can learn from for the future. Okay, thanks.
Thank you, Katja. The next discussant is Paulo. Paulo, you're online. So
hello. Yeah. Can you hear me well?
Very well. You can share your screen.
Yeah, sure. So thanks a lot, and sorry for not being able to make it in person. Can you see well, or?
Yes, we see your nose on the side, but.
Okay,
sorry, Paolo, we see the presentation mode. We don't see
yeah. Let me do this instead. Is it better?
Yes, perfect. Thank you.
Okay. Thanks a lot for the opportunity of discussing this very interesting paper that I also saw presented in an earlier version before in Milan. So let me summarize very quickly the paper, also because I'm the second discussant. The key contribution of the paper, I would say, is this survey on parents of about 2,000 students in 2021 that was linked with a longitudinal component to an earlier survey that was done about 1 year before, and reported a long battery of self-reported outcomes, and actually also self-assessed by the parents in many cases. So the main results are a drop in learning time, huge drop in 2020, as you can imagine, and maybe the most pessimist news is this only limited rebound in 2021. Daily online classes were most effective in sustaining the learning time, and there was time substitution towards what I call screens, so TV, video games. And there's actually not very clear evidence about impacts on social emotional well-being and cognitive development, which is kind of a surprising result in some respect. And also, I would mention that another contribution is this very extensive review of the literature and the discussion of the policy implication. So I certainly agree with Katja that actually the paper has a lot of novelties that doesn't need really the discussion of the literature to be a very impactful paper. But still, I found it quite useful because anyway, we are like hopefully a bit out of the pandemics, but this is exactly a moment in which we should try to understand what has been going on and possibly which are the long-term consequences of the pandemics on children well-being. And in this respect, I found the discussion of other papers in the literature to be very useful. So let me go back to the first main contribution, again, the survey. So it's certainly fundamental because there's, as of today, still very scarce information on welfare and the behavior of children and families during the pandemics. And as already mentioned and emphasized actually by Katja, the longitudinal dimension is particularly useful in this respect. I would try to, maybe emphasize the importance of the survey by, for instance, describing more the data, right? So the geographical distribution of respondents. So, for instance, I guess it could be useful to have a map in which you can, plot the dots of people interviewed in the earlier wave, in the later wave, and those, that were interviewed in both, to have more information about the parental background. So as far as I understand, some of this information may be reported in the previous paper. There was an earlier paper about the first wave of the survey, but I think it would be nice for the river to have a self-contained version of the current paper in which there's also, also these descriptives are provided. So let me try to pick some comments or suggestions about the survey. So you define low achieving children as those with below median grades by school types, and conversely, the high achieving students are those with above median grades by school type. So in addition to the more general issue that this information is self-reported by the parents, so there may be some biases or some measurement error. I also wonder whether these grades are normalized within schools or implicitly or explicitly. So in some countries, they are explicitly normalized. In other countries like Italy, there's no explicit rule, no strong rule about that, but we know that teachers, they tend to give more or less a similar distribution of grades within schools. And so, I think this would be important to understand what we really mean by high achieving or low achieving students, right? So it's really high achieving in absolute terms, or high achieving within a particular school that may be, a school in a poor neighborhood or in a rich neighborhood, and this would make a lot of difference. So in general, I think again, I don't want to, I don't want to underemphasize the importance of the survey. As I said before, it's probably one of the best sources of information that we have about these issues as of today, this topic. But I think it could be useful sometime to discuss a bit more which are the specific biases that can derive from the fact that most or all information is self-reported, right? So there are some statements like this one. There are obvious limitations of survey-based data, limited measurement of skills, self-reported assessment, and so on and so forth, but these are quite general, right? So I think it could be useful to be more specific and more open about, okay, that this type of measurement error could lead to this bias in this particular descriptive table or in this particular regression. So I could think, for instance, about one example. So inequality is a main concern, right? Also, Katia mentioned that, right? So we want to understand whether the pandemic and school closure, they impacted differentially children from richer or poorer families or higher or lower socioeconomic status. So I wonder whether difference in the perceptions of self-efficacy by the parents can differ by education or socioeconomic status of parents, right? So this finding that it was shown that, the parents from high socioeconomic status or from, high performing students, which are, of course, very strongly correlated. So they claim to be that education at home is more effective compared to the other parents. So is this really true, or is some type of, self-perception or bias or stereotypes that parents have about themselves, right? So, for instance, these sort of things of issues could explain also why there are some results that, they are a bit counterintuitive, right? So, like this one that I mentioned, I think also Katia mentioned something like that. So most parents do not report changes in most dimensions of their children's social emotional well-being compared to the pre-pandemic times, which seems strange. On average, there is even a slight tendency for improvements in the areas of emotional conduct and peer problems. Again, it could be an interesting result, but for sure it's a bit counterintuitive. So I think it would be good to discuss a bit, whether there are some potential sources of measurement error that could drive in part this result. Of course, one of the best solutions would be to merge these people with the students with some administrative data on test scores or even standardized test scores. But I don't know whether this is feasible or not. I guess, I mean, if it was not done before, it's probably very hard or impossible. So yeah, I just leave it here. And then a couple of more specific comments. So I think it would be good to discuss, of course, a major confounder is that in addition, I mean, the pandemic actually brought a severe economic crisis, right? So in Germany, like in most other European countries, most other countries in the world. So I think it would be interesting to compare, you know, the results for what is possible with previous evidence about, I don't know, students dropout or other measures of students' performance during previous recessions, right? And then I understand, in a sense, Germany is just one data point, right, for this paper, so we cannot really compare with other countries, but I wonder whether there was some variation in GDP changes across areas, across regions in Germany that could be included in the regression, for instance, in table 2, if I remember well, so in the multivariate regression, so include changes in GDP, or maybe even just area fixed effect to compare students within the same region that were therefore exposed to the same type of shocks. And then, well, again, about the regression, again, it's a very specific comment, but I would not control for parental inputs, right? So you show the results with and without, and you say that it actually doesn't change the result that much, and so you keep it in the baseline specification, but I think a bad control remains a bad control, so I would just take it out from the regression. Finally, just an issue about the presentation of the results. So there are several graphs instead of tables, which I like in general, but I just think that, you know, this graph on the left is very easy to read or it's readable. The graph on the right, so when you start having too many categories and too many rows, this becomes a bit harder, at least for me, to read. So I think in some cases this could be substituted with tables, or you could instead try to aggregate, you know, the most extreme categories together, right? So to conclude, I think it's a great overview of the state of the art in this area of research. The survey is much needed because, again, I mean, I was trying myself, and other people here in Bocconi were trying to learn something about the long-term consequence or even the short-term consequences for students of school closures, and we realized how hard it is to find information in this respect. So I was wondering whether this could be a useful pilot for a larger scale up, right? In which, with some retrospective question, we could, you know, try to match more parents and more children in the survey, and then also try to match them with administrative data, as I was mentioning before. It's just food for thought. And yeah, to conclude, I think it's also very useful from a policy perspective. Hopefully, there won't be much need for that in the next years. Hopefully, we'll become, you know, better able to deal with the pandemics, limiting at the maximum school closures, but, you know, just in case, you never know whether we will need to go through that again. Thanks a lot.
Thank you very much, Paolo. So are there questions? Yes, Gazala Azmat, Sciences Po.
Thanks. So first of all, thank you very much, Katerina, for a very nice presentation. I just want to pick up on a couple of things which have come up lightly in the two discussions. So one is the age difference. I think it's really important to look at the effects on young children, especially sort of primary school age children versus adolescents, because in terms of development, they're quite different. And so just the heterogeneity there can help us understand, especially the parental roles. And it can be for many reasons. So their stage in terms of development, but also in terms of the parental capacity to actually help them with their education. And I think that might help us understand also differences on the socio-emotional development. And then two other points. So one is a little related, but the presence of siblings in the household and the age of those siblings, because again, I think part of what happened during the sort of school closures is that people were, children were losing their peers. And so the kind of way in which the households were might have sort of had an effect on that as well. So at least just looking at some variation there. And then the other relates to the sort of geographic variability as well, because, given that restrictions across different German states were probably kind of, stronger or weaker, the length of the closures. So I wonder if there's a way in which you can take these into account as well. To help us understand sort of why there's some, because I think, what you're finding is very interesting, and some of this heterogeneity, it would be nice to understand a little bit more what's behind it.
Thank you. Émeric, Henri, Sciences Po.
So quick remark, more of personal experience. So we realized during the pandemic that how difficult it is to teach kids at home. So I wonder if people ask that question, actually, is there a change of perception of the work of teachers post-pandemic? Just a curiosity, nothing to do with the actual presentation.
Felipe.
Yeah, very interesting paper. Thanks a lot for that. Along the same lines of what Ghazala and Paula were saying. I agree that maybe income is bad control, but it'll be interesting to explore the heterogeneity a bit further. And maybe the other dimension that you could look would be like single parent households versus married households.
Moritz Kuhn.
Moritz Kuhn, University of Bonn. I would be curious about these socio-emotional changes, and whether the COVID recession is particular in the sense that other recessions or situations like the financial crisis were different, where I could also imagine that if the economic situation of the household somehow deteriorates, this also leaves a footprint on the socio-emotional development of children. And then also, like related to what Katja said, I guess these answers about the quality of schooling at home, or like how much children are learning when they learn at home, might be a little bit hard to interpret, because you get all the additional parental input into the learning process. So I guess if you were to ask parents, do you think the quality is so much better that you should always do it at home? You would get probably very different questions in terms of the margin, or like the consideration about whether it's so much better that you would give up your job and teach your kid at home. And I think in general, I would be curious if there's any way to somehow compare your answers to other measures, in terms of parents looking at their children during the pandemic might have a very different, or pay now very differently attention to certain topics, maybe particular mental health, where they would have before not realized this, but now, just because everybody is talking about this, pay more attention to this. And also smaller changes might now be perceived as being much, much bigger than before. Thank you very much.
Thank you. Roberto Galbiati.
Roberto Galbiati. I tried not to speak too loud, because otherwise. So I was thinking about one thing. I missed it if you already said it. One of the things that characterizes Germany with respect to other countries is a low labor market participation of female. So how this may affect your result and make it comparable to other countries like France, where female participate much more. So they were home working, and they had, and so obviously both the parents had to work at home, while the characteristics of the German labor market are such that women probably could be more dedicated, because they did not have a job to start off.
I also have a question about the long-term effect. I think there is much uncertainty there. So there have been some papers. Sorry, I forgot some. Okay. There have been some papers, for instance, by Eric Morin, looking at the impact of strikes, indication showing no such large impacts. So it would be nice to kind of refer to this literature to see. I mean, to have some comparison there, because there is much uncertainty there. Yeah, I think about the conclusions. Oh, sorry, I don't see you. So, Ricardo Reis.
Actually, following up on what you're saying and on the persistence of the effects, I mean, so I'd encourage you to, even though this paper will get published, to actually keep on doing more of these surveys, if not once a year, but every 5 years on the same population. Because I think there's some very important open questions that the existing evidence can't answer because COVID was just so different in terms of how large it was. And I wanted to flag 3. First, on your results on the on mental health, to what I would be very interested to see whether in a few years these results change completely and whether they're much larger or much smaller. That is, I mean, it is quite a social experiment to lock young people with their parents at home for a while. We certainly see already reports of very large increase in mental health caseloads in social work. Are these bigger? Do these correlate positively or negatively with education the kids got at home and the time the parents spent with them? Actually seems to me like an interesting open question that would be interesting either way. I don't actually have a strong prior on what it would be. Number 2, and as one looks at the age of children, I mean, we think that as people get older, some of education is as much human capital as it may have a little bit of signaling. This was a very peculiar experience because all of the kids were sent at home. The signaling, is it coming through formal years of education or through what you actually learn at home? You would think that, again, the signaling can either become much larger or much smaller. And either way, I think it would be important and interesting to see once you start seeing the wages of these people or not. And finally, thirdly, perhaps the more challenging, and maybe you can see it now, and this is a challenge for the literature that you survey. If these effects are so large, why don't we see that much of public policy to catch up and keep schools open during the summer for the next 3 years? It seems to be universal across country. Almost no country I hear of is doing this. Almost no state in Germany is doing this in any kind of significant way. It's a little bit of a puzzle. I mean, if the effects are quite so large, is the blockade is really of the teachers' unions or what it is so large though as to offset this completely? Insofar as you have all this variation, you'd at least expect that some places do it a little more and some others a little less. But it seems that everyone's at the corner of not adjusting the school calendar at all in the future. That seems puzzling to me, given the results of this literature.
Any more questions? So, Katerina, you have some time to answer some of the questions, perhaps.
Thank you. First of all, thank you all so much. Those were all very interesting points, especially thanks to my discussants. I think one of the challenges we have in this paper is how to organize the large amount of data that we have. And so these are super well taken. And maybe one point of caution is we do have fairly small sample size for the panel component, which will limit our ability to look at very kind of specific subgroups, unfortunately. But I completely agree with all of the hypothesis raised, and I think it would be very interesting to see if we can find more evidence, in particular on the interaction of parents and schools, if there's anything more that we can do to understand to what degree parents might have tried to substitute for kind of school outcomes. One of the things that we see just in the averages and the aggregate is that it seems that groups that experience less kind of school activities also experience less parental support. So that kind of is a very high level indication that maybe it was hard for parents to substitute missing school activities, which I think would also be consistent with the structural literature or the assumptions that are often made in that regard. Yes, so I think there's so many interesting points here. On the SDQ differences, so it is possible that parents struggle to compare. One thing I should also say about our SDQ results, is that we don't really have them across time. So we can't really compare the assessment that parents make across time. We only ask them to make this comparison themselves. I would argue that for a lot of the other items that we have, we actually see very small tendencies to the middle, as you would call it in survey research, where parents just basically choose the middle category. But there's definitely some element where parents might now spend more time with their children. They might also spend much more time with their children in activities that they didn't prior kind of observe their child, and maybe they didn't try to sit down and teach them math. And I think this actually comes also to Paulo's point that it's very important, but also very hard to think about all of the different ways in which kind of the way that people answer the survey might kind of depend on things that change in the pandemic. And I think this is also a point that was made in the discussion. One of the problems maybe we have with trying to identify the effects of school closures also, I think, especially when we talk about the socio-emotional skills, is it's impossible to really focus on the school closures here because they just happened at the same time as all of the other lockdown policies and all of the other factors that were changed by the COVID pandemic. Maybe one quick point. So we do have information in our survey on the numbers of hours that parents spend working at home, or kind of also the numbers they work spending outside of home. So the reason we haven't explored that so much is just because of the dimensionality of it all. But so I think maybe that is something that we could actually say more about, also kind of talking to the comments that were made about the impact of the economic crisis on top of the COVID crisis. I would argue that in Germany, because of stabilizers that basically were got activated at the beginning of the COVID crisis, probably the economic turmoil might have been less than in other countries, but it would definitely be interesting to explore that more. I just want to make one final comment. So there was the idea that hopefully our results would not be needed in the future. I just wanted to push back a little on that point, because I agree with you. I hope that this is not going to be a problem that we will be talking about in 5 years. But I think in order to make that true, we would be very well advised to keep kind of a close eye on how students are doing once they return to school, especially something that was also mentioned here. There seems to be a certain inertia and maybe a reluctance of the education system to really kind of revolutionize in the aftermath of the COVID crisis. And in particular, if we look at our results, what we could face is a situation where students go back to school with vastly larger differences in their education attainment and basically the experience they had in those kind of years of school closures, which will kind of pose a huge new challenge to teachers that are now supposed to teach a classroom that has just much larger differences between the achievement levels of different students. And so I think it would be really important to keep a close eye on this and hopefully continue to collect good data, maybe even kind of administrative data rather than just survey data, to make sure that we are moving towards remedial policies.
Thank you very much. Yeah. Okay, now the last paper on the session. Katarina, so about nudges and threats, tax compliances.
Okay, thank you very much. And thank you very much for organizing this really interesting conference and giving us the opportunity to present our paper and hopefully getting lots of valuable comments and discussion points here as well. So this is joint work with Henrik Andersson and Per Engström from Uppsala University and Susanna Vanander from the Swedish Tax Agency. So let me first give a short description of the study, what we actually do here. So first of all, this is, I think, a very fruitful collaboration between researchers and a public authority. So, and we've been closely collaborating throughout the whole process here. And what we do is that we study the population of delinquent taxpayers who have not paid their taxes on time. And we use data for 3 subsequent years. So we can say that this is, I mean, rather special group of people that we look at. And the simple question we ask is, what makes these people actually pay their taxes due? So we have people who have not paid their taxes that they were supposed to pay, and how can we make them pay their taxes? So what we do in the paper is that we compare the existing policy that is currently used by the Swedish tax agency. And then we compare that to an experimental intervention. So the existing policy is a kind of a threat of standard enforcement. So I will, in a few slides, I will explain exactly what that is about. And this is a kind of a natural experiment. So depending on the size of the tax debt, taxpayers are treated differently by the Swedish tax agency. So if you have a tax debt below 2,000 Swedish kroners, I mean, nothing really happens. Whereas specifically at 2,000, then the threat of enforcement kicks in. So we make use of this legal threshold when we analyze this threat of enforcement. We also, in the paper, we also look at the execution of the enforcement. How does enforcement itself affect payments? But I won't have the time to go through that today. And then we compare that to the effects of nudges in the form of various letters. So nudges, as you probably know, that things that have no economic significance. They shouldn't affect a rational economic decision maker. But we know, I mean, from experience that they do something to us psychologically, so they affect our behavior anyway. So here we use a randomized controlled trial when we look at the effects of these various cover letters. So that's in principle what we do. And what do we find then? Well, we find that the existing standard threat of enforcement has actually strong effects, which is of course good news for the tax agency that, I mean, their policy, it works as it should. But we actually find that just including a completely non-informative cover letter, what we call a pure nudge, that has almost as strong an effect on people's tax-paying behavior. At least for those where stakes are low, that is, those who do not risk enforcement. We also find that a so-called moral nudge. We also have other letters where we allude to social norms. There we find an effect both from those who do not risk enforcement and for those who do. I will just say a few words on related literature. Of course, there are lots of studies on tax compliance in various ways. So there is one, yeah, you see it, of course. One recent meta study where they have looked at, I think it's about 40 tax compliance studies including kinds of nudges. And of course, I mean, they have lots of different kinds of tax behavior, but what they find is that it's very different across different studies. One study that has inspired us a lot is the one by Halsworth and co-authors, where they also look at delinquent taxpayers, and they have lots of different nudges and lots of different letter formulations. And they find a very large effect from what they call the minority norm, where they say that most people pay their taxes on time, and you belong to the minority that hasn't done that. And we actually, as you will see in a few slides, we make use of the same formulations there. Another recent study worth mentioning is the one by Deneuve and others, where they, so this is in a Belgian setting, and they are looking at several stages throughout the taxation process. And what is important to us is that they find that simplification that always increases compliance. They find that deterrence messages are effective, and that is comparable to our threat of enforcement. And they do not find any positive effects from social norm nudges. So here we see that they differ a bit. Just to give you a brief overview of the institutional settings. So how does tax payment in Sweden work? Well, during the income year, employers, they withhold preliminary taxes. And then the year after, plotted for 2018, which is one of the years we include in our study, taxpayers, they file their taxes, and then the Swedish tax agency, they calculate the final tax. And then they compare that to the preliminary taxes that has been withheld. And if the final tax exceeds the preliminary tax, then you will have to pay the difference. And in that case, you should pay by late November. And of course, most people do. Some of the people, they don't. And they receive a letter from the Swedish tax agency in early December. And this study is all about this December letter. So what happens to people's behavior once they have received this letter? So those letters, what are they? As I said in the beginning, it's a bit different depending on the debt size. So if the tax debt falls below 2,000 Swedish kronor, it's a standard reminder. So of course there will be an additional interest on your debt, but there is no real enforcement. But if the tax debt is at least 2,000 Swedish kronor, then this letter is a threat of enforcement, saying that if you don't pay in December, your debt will be transferred to the enforcement agency in January. And the enforcement agency, they carry out enforcement not just for tax debts, but for lots of other issues as well. And it means both that you have to pay another extra fee of 600, which is substantial if you have a debt of 2,000. And then you also risk payment default, so that you cannot rent an apartment or get credits or things like that, or you may even get a distraint order. So these are actually severe consequences. So what we would expect from an economic point of view is that people would react stronger to this threat of enforcement than to the standard reminder. And to see whether that is the result, then we study this by a regression discontinuity analysis, and we do that for tax payments in 2 years, 2016 and 17. So what we study is whether people pay in December. We also look at when they have received this threat of enforcement. We also in the paper look at longer term payments, including the actual enforcement. And then, of course, in this RD analysis, different behavior to the left and to the right of the cutoff, that is the debt of 2000, should only be attributed to the treatment. That is, that you actually got this threat of enforcement. And for sufficiently small bandwidths, it should be completely random if you end up to the left or to the right. And of course, we do lots of different things to make sure that that is actually the case. For instance, we omit everyone who is self-employed because they have some kind of a discretion on their reported income and tax payments. And we do lots of tests. So, and the McCrary tests that we report also in the paper, they are reassuring that this is actually, we can be safe that we actually have, that any effects that we can observe, we can actually interpret them as causal effects. So what do we find then? Well, it looks like this. So to the left here, so this is then the debt size. So here to the left, it's those who just get a standard reminder. And to the right, they get the threat of enforcement. And on the y-axis, we see the share who has actually paid to the Swedish tax agency. And what we see is that we get a strong and significant effect in payments. So from about 58% who pay if they just get a reminder, we get like 67% who pay if they get the threat of enforcement instead. So we can conclude that there is a strong effect from this threat of enforcement, which does not come as a surprise for us as economists. We think that economic incentives matter. But of course, this is a drastic measure, and it's expensive both for the individual and for society as a whole to actually send these people to the enforcement agency. So the question is, could we make these people pay with some milder measures? So therefore, in 2018, we tried then to nudge people to pay. And we did that by adding different cover letters to the existing letters. So we couldn't do anything about the existing letters. I mean, the tax agency sends these letters and they have a certain structure, so it's impossible to or it was by then at least impossible to change them. But we added just cover letters to see what happens. And then we did that for everyone between 1,000 and 3,000. So we had this this natural threshold of 2,000 where something also in economic terms actually happens in the middle. And then we send letters, cover letters to everyone. there between. So this is a picture of our research design with different debt amounts. So this at 2000, where we look at the threat of enforcement. I've just talked about that. And then we sent experiment letters, and I will go through all of them. So starting with the neutral letters, that is the letters that they don't actually include any information. On the next slide, I will show the exact formulations. And since everyone between 1,000 and 3,000 received some kind of a letter, we actually make use of the same research method when we evaluate the effects of these neutral letters. So we do regression discontinuity analysis around 1,000 and around 3,000. So those with a 900 kroner debt, they just got the standard reminder. Those with 1,100, they got the standard reminder plus this neutral cover letter. And the same, of course, at 3,000. So this is what it looks like. And what does it mean? Well, in the letterhead, it says important information. And then here comes a reminder that you have to pay your tax areas. And of course, that is, I mean, more or less what we did. I mean, this is no new information. And what about the effects then? Well, we see that we actually get quite a substantial effect. So from this, like 58% who pay with just the reminder, we get another 7 percentage points who actually do pay when they receive this just non-informative letter, if they don't risk enforcement. So this is what we see for those at the 1,000 threshold. At the 3,000 threshold, that is those who got the threat of enforcement, we find no effect at all. So this pure nudge, it affects those who do not risk enforcement, but not those who do. And then we could say, okay, why is that? Well, from a theoretical point of view, from the nudge literature, it's been shown that unimportant choices are easy to nudge. Important choices are more difficult because then people actually start thinking about it. And of course, the consequences are much more severe for those at the 3,000 cutoff than for the 1,000. It could also be the case that this hard threat, I mean, at the 3,000, I mean, they already get a strong threat, so they perhaps that wipes out the effect of the mild nudge. Okay, we also have some other nudges. So we use this minority norm from Halsworth and al., saying that more than 9 out of 10 people pay their taxes on time, and you belong to the minority who do not pay us. And we do that the same for both those who risk enforcement and those who don't. But then we also, for those who actually risk enforcement, we also give a short and very brief explanation of what does it mean to get your debt transferred to the enforcement agency. And then we have then also a combination of the second and third. I don't have the time to go through exactly what it says, but it's very, very brief what it's about to get everything handed over to the to the enforcement agency. So the effect of this minority norm below 2,000, those who do not risk enforcement. Well, so this is then in addition to the neutral letter. So then we see that we get another like 2 percentage points when it comes to payments. For those above 2,000, remember we have no effect of the pure nudge, but we have effects both from this social norm, but also from the brief information of what it actually means to be sent to enforcement. And these differ a little bit, but they are not significantly different from each other. So here we actually see that if you write something that actually means something, then it matters also to those who do risk enforcement. So to conclude then, so the existing threat of standard enforcement, it increases the likelihood of tax payments by 9 percentage points in the immediate run. So if you get this letter with a threat of enforcement from the Swedish tax agency, I mean, within a few weeks, that increases the payments. But we also find that we get an almost as strong effect from a pure nudge, that is a non-informative cover letter. So then we have, I mean, like 7 percentage points among those who do not risk enforcement. We have much less effects from those who do risk enforcement, but we still find an effect from a moral nudge and from this brief information. And some back of the envelope calculations show that the most effective formulation, if we have used that, would actually save 4% of the delinquent taxpayers from ending up with the enforcement agency. And as a concrete result from this study, the Swedish tax agency has now started to reformulate their letters because perhaps they were not clear enough. And it's not just for those letters, but also for other letters that could affect people's payments. So thank you.
Thank you very much, Katarina. So, hello, Giacomo. You're discussing the paper online.
Hey.
Please share your screen.
There you go. Can you see it?
Yes, you can go.
Great. Is the audio okay? Can you hear, right? Cool. So let me apologize for not being there. This was actually, unfortunately, an emergency a couple of days ago. So I had booked everything. So I was supposed to be there and I couldn't. So apologies for that. And apologies to all the other presenters that I haven't seen before this afternoon. I just got, something that unfortunately happened. Now let's move on, I guess, to the paper. I did enjoy reading the paper. This is not my extreme area of expertise, I'm going to say, but let me just try to summarize and discuss what I get out of the paper. So definitely it's an interesting paper and definitely an important topic. Raising taxes, tax basis seems to be a worthwhile exercise. I think it's commendable that the researchers managed to actually have a strict collaboration with the Swedish tax authority. That's actually not a very simple thing to do. So that's really important, and hopefully this will generate future collaboration and so on. It's quite important. Now, there is an important link that is missed in the paper that I actually just find out because I was just looking at some literature on that. Stefano Della Vigna and Ecuador have a nice paper where they actually look at nudges in the academic research versus government nudges, and they sort of find, that this basically the other magnitude of what they find is very much somewhere in between what this paper finds. And I think it's important to make a connection there, because this paper is really, you should think about it as a at a scale intervention rather than an academic intervention. So it should be closer to the 1 percentage points, which actually in some of the estimates it is. But I think it's important to notice that it's not just standard RCTs run by researchers, but it's actually with the authority supposed to actually to run these things. Now, one thing that I learned, and I didn't know this, is that the Swedes don't always pay their taxes. So I thought that it was just not even an issue, right? And in fact, you see the BBC seem to believe that Swedes are very happy to pay their taxes. So someone doesn't. We learned for sure that federal enforcement works. I have a different take on whether nudges work entirely, but we'll get there. There's some additional, I think, effects on these extra treatments above 2,000 or 200 euros or whatnot. I'll get back to that. Now, one thing that is I think important to understand here is, who are these people who don't pay the taxes? Why don't they pay? Why am I saying this? By all accounts, I think these are very small amounts that are missing from the tax base. 200 euros, 225 euros, 300 euros in this range. And a lot of these people actually are missing 5 euros. If you look at the distribution of missing taxes, there's a lot of people closer to the 5 euros that are closer to the 150 euros. So this has to come from somewhere in the way the taxes are paid and the way the tax authority basically gets back to the taxpayer. This could be, basically because there are some deductions that have been claimed by the workers and not accepted by the tax authority, some litigation on what's what, because these are ultimately the people in this experiment and in this evaluation are people who are employees. So their taxes and all their contributions, I think, are directly taken by the employer and then directly given to the tax authority. So these are not people who have a lot of discretion in what they do. And they end up actually having these debts that are pretty small. So I think it's important to understand who these people are and why this happens, just because we want to know more about how important this paper is with respect to the general and grand scheme of things, where you want to actually raise more taxes out of the general population rather than just specific people. So, oops. Now, the federal enforcement, as you have, has been well explained, basically is estimated through an RD design, and it's at the threshold of 2,000 bonus, I think. It's about, again, I think it's about 200 euros, something like that. I have the number somewhere, but I forgot now. So the effect seems to be sizable, well estimated, etc. And if you take somewhat the longer run effect, which I think is interesting per se, it's the December to February. So in December is the first time that you basically get to know that you have to pay the taxes, reminded, I should say, and that you have this enforcement threat. And then, eventually this can be transferred to the enforcement agency and so on. And at that point, you have a 20 percentage points effect, which is pretty sizable, I'd say. I'll go back to this actually later. Now, there's some minor issues on the selection of the bandwidths. It always comes about with this methods and so on. But one crucial part, I think, for interpretation of the results and how to essentially combine this observational variation, so the RDD, with the experimental variation of the different letters, is to understand how these numbers extend out of the thresholds. So Paolo was here before, and so Paolo has an application of this in a recent paper, but this is basically sparked by some work of Mika Rokkan and Josh Angrist in JASA 2015. This was actually part of Mika's job market paper, by the way. And so it's basically how to move away from the threshold and what do you need in order to move away from the threshold. When you are comparing inframarginal effects to these marginal effects at the thresholds, you really need to understand whether whatever you're using as a late is actually comparable to what you would find in the middle of the distribution. And so I think you have the chance actually of doing that because you have all the information about these people, and it's just a conditionality assumption. Of course, it's an assumption, right? At the end of the day, but it would be interesting to know that. And I think there is actually a lot of heterogeneity in that. But it'd be interesting to know whether you can actually extend this way. Also, in general, we care about larger debts, I think. And so what do we learn for the 200 euros? Is this applicable to the, 5,000 euros or something like that? Now, again, I'm not a board expert in this literature on nudges or taxes or anything probably. Now, it seems to me that what you consider, and I think it's important for the definition and understanding of the effects, what is considered as a nudge per se is actually not exactly, because the letters contains also other information. Now, if it's additively severable with the other one, you say, well, that information is already there in all the letters. I never know if that's true. I don't know whether we believe that. Also, I went through the letters and I thought that most of them contain a mention of the enforcement agency. What they don't contain is, the extra text that says, well, the enforcement agency can do something like, well, prevent you from, so basically declare you insolvent and prevent you from borrowing, getting a credit card, or, sorry about the noise. Might be a tax authority. So it's important to really understand what letter one, the neutral/nudge letter, actually contains, and then how the other interpret that. I couldn't really figure out from the text, and I think it's because the letter contains more than just a nudge. Now, for the experiment above the 2K, we need to again establish what is the letter that we are comparing things to. So, and we need to understand that because it's important for policy discussion. I don't know how we can rule out that the different letters contain, by definition, almost a threat of enforcement, because the mentioning of the enforcement agencies in there. I have somewhat, I don't think enforcement is the right definition for transferring to the enforcement agency, because enforcement is actually the seizing of the money. So it's enforcement of the contract or the due. That's what enforcement is. I think it's still threat of enforcement, but it's not very important. Now, there are some interesting things about how the letters work in the shorter versus the longer run. So when you look at the dynamics of the payments, it seems there's a let's say 3 percentage points or 2 percentage points effect across the letters with respect to this neutral letter. Again, I don't know exactly what that is. But then, if you look at the later observations, what you see is that these effects are actually halved or sort of that. So in a way, I'm a bit curious to understand what happens after February and why is February the essential month that you're looking at. In a way, the control mean is pretty high, it goes almost to 85%. There's one part, that's also important, and I'll come back to that in a second. And it's this. So this is effects of late versus early. It's February, the last month. We can look at what about the next 3-4 months? What about 6 months? Are these effects going to disappear in 6 months? I don't know. It'd be interesting to know. As I mentioned before, and now I'm going back to this, these are small debts. If I'm not mistaken, I said it's about 200 euros, 300 euros, something like that. And a lot of this are actually below, well below 90 euros, which begs the question, and I'll get to that in a second, of why do we need to try to do something about this? These are potentially people who have some issues going on, either with the tax system, with the way that, anticipated contribution are being withdrawn, or they actually can't pay really. Now, what is moral hazard versus ex-ante exploit? I'm not going to get into that, but these are very small amounts, and yet these people are not paying it. And of course, cumulatively, ultimately, if they don't pay, they will end up in the enforcement agency, just dynamically. It's a way it's going to work. So maybe that's an important thing to think about. So there's a way that you can actually look at the effects of the letters across the distribution of incomes and debts. I guess it's basically what you're trying to do in table C4, but I would like to see some interaction with income and so on. And now I'm getting to the last part, which I guess it's maybe the interesting one to me, but it's it's about cost and benefits. I've done it really taking numbers almost randomly from the paper. And so I would really love to see a proper cost and benefit analysis here. I think that's what is very relevant for this type of paper. Now I took the numbers from the paper and I've done a lot of guesswork. So forgive me if some of these things are completely off, but I might, as I said, mildly overguess stuff, or wildly more than mildly. So the additional effects of the letters, if I just take as an additional effect, okay, so these are 2 percentage points, but we can take also the 10 percentage points. It's just a base to start with. The number of people are about 22,000 in the data, and I think this is the universe, but again, so what I'm gonna get at is that even if you recover all of this, you're gonna recover small amounts overall. Like, if you think this is an additional 2 percentage points effects, you're gonna recover, given the numbers, 100,000 euros. Yeah, and the letter is potentially quite costly. Again, this is an additional letter, so part of this cost already borne by the fact that the administration does that no matter what. Now, if you put environmental cost to infinity, printing and sending stuff, it's infinity costly. So even that, it seems to be a crazy idea. But just if you take the postage per se, it's basically 1.3 euros. I checked this on Google, so this is actually the only number I'm sure about. But essentially, the cost side it's substantial for getting this, if this is just the additional effect. But you can multiply the benefits by 5, by 10. Still, you're getting to not gigantic amounts. Now, and again, this is a big caveat, so this is in red. Maybe this is not the best venue for advocating to getting rid of the enforcement agency, but if you think about the numbers and you take the largest estimates from table 1, 20 percentage points. And the population that is affected above that number and so on and so forth, which I guess to be around 30,000 from figure A1. But again, this should be done properly. It seems like that the tax revenue effect of this is actually in the order of magnitude of 1.5 million euros. And I might be wrong on this, right? Because the numbers I'm just getting out of the paper. I don't know exactly the entire universe of this, whatever. But, so my guess is that the enforcement agency is actually more expensive than that 1.5 million. So there has to be something I'm missing here, or it's something very important that it's amiss in the description, because this seems to be, a lot of potential damage and expenditures, even just more expenditure for legal returns. This counterfactual is not very fair, because the non-existent enforcement agency may actually lower the entire tax base to get started, right? But if we take these at face value, it's quite, I don't know, to me it deserves a proper cost and benefit calculation because of this discrepancies between, I think, how much it costs to maintain such a system and the people they've been going after with very small debts. Maybe there's a better policy than just going after them. It's, if we're talking about 200 euros, and these are coming from people who actually have, these are employees, so they cannot really do much. There's something off there, and so I don't know.
Giacomo, you should conclude.
I'm actually done. So the minor points are
done.
I'm totally done. This is actually where I want to go. So I really would I love to see a cost and benefit calculation. That it's not like mine was actually a proper one. Mine is a lot of guesswork, so I apologize for that.
Thank you very much. So. Emmerich, the last discussion.
So I'll take the opportunity to thank the organizers and everyone, and to publicly apologize for always sending my slides late. So, and I know that people are worried about their planes, so I'll be efficient, especially Ghazala, apparently. So it's not completely easy to discuss a paper which is a large RCT like that. So in terms of suggesting changes, you're not going to rerun a different experiment. So I'm going to mostly focus on how you should probably place the paper in the literature, and also what kind of message I think you should emphasize. And I think you're trying to put too much, and the message is lost in in the way you present it. So I didn't know much about the literature, so I went back and tried to organize it a bit in my mind. So that's what I'll start with. So there seems to be an exploding literature sending different messages to taxpayers. Okay, so these RCTs with different messages, and you can organize them in the following way. So there's papers that differ in what margin they look at. So is it the actual reporting? Are you trying to evade taxes? Or is it the payment of debt that actually has been formalized? And they vary in terms of the messages that can be sent. It can be sent when they can be sent, at the filing stage, at the payment stage. And so here you place yourself in the blue. So you look precisely at the debt repayment, and you look at the phase where the taxes are already late in their payment. And so I think it should be very clear, because the mechanisms seem very different for evasion margin and for the debt repayment margin. Then there's the problem with nudges is that you can write, there's an infinity of messages you can write. So you could change a comma and it's a different message. So it's a bit, the problem of this literature is that it can go in many directions. And so I'm trying to organize a bit. There's some messages that are threats of audits and seem very effective. Some are information on the process, how to actually pay your tax. Some are enforcement reminder, and that's one you actually do. Some are social comparison, and some are boosting tax morale, which is explaining what taxes are useful. And those that seem the most effective are those, in particular, seems to be enforcement reminder and the threats of audits. So there's already this kind of enforcement idea that's behind it. So at this stage of the literature, I think it's a bit confusing because there's so many messages, there's confusing conclusions. It seems to be going in a lot of directions. So apparently you mentioned a meta study. There's clearly an urgent need for a meta study. So I don't know what exactly is in this paper you mentioned. But I think there's also a need for organizing these messages and understanding what mechanisms are actually at play and formalizing them. And I think that's where maybe you have the more clear contribution. So in terms of the placement of this paper, I think you have first the direct comparison between enforcement and the nudge. Second, and more importantly, there's this very surprising effect of the placebo message. I call it a placebo message. It's basically, it doesn't say anything. It just says, we're here, okay? We're looking at you. And I think you can reinterpret a lot of the messages in the literature by having this component embedded in it. So when you have this message, for instance, 9 out of 10 people in the UK remit their taxes on time. You are currently in a very small minority. You having a lot of mechanism activated. You have this placebo effect. You have the social comparison, and you're always also telling people that we know things about you, so we are watching you. Okay, so there's understanding, unpacking these messages is super important. And so I think that's your contribution, is to show that even a simple message has an effect, and this is the baseline that you should compare the other messages with. So Giacomo insisted twice on this. I add a third time. The stakes are super high, and what's not surprising is that it works. So what's surprising is it doesn't work more. And so I think you should really dig into why we don't get to 100% when you have so low stakes, and the threat is really being barred from being able to rent or actually make transactions. So why is it so high? So first, one idea would be information provision. Because when you look at your letter, let me just put the letters. This is the original letter. So I don't speak Swedish, but I understand it's quite hard to navigate. So there you say, this is the payment, they say it's payment, the tax due. And then in the second page, there's a paragraph that tells you maybe it's going to be sent to the enforcement agency. So clearly the tax authority needed your help. But I'm wondering why we didn't figure out that this thing was a bit problematic. Okay, so it's a bit, so information could be an explanation, but you show it's not the case, because you have an information treatment that explains the thing, and the information treatment works at the beginning, so it makes people pay earlier, but it doesn't change the eventual payment rate. So it's kind of cannot be explanation. Second explanation is actually people can't pay, and one possibility is that they're already in default. They're already with the enforcement agency. So you really need to understand who are these people, because it matters for your welfare implications. And I mentioned just administrative phobia. So what is this? So it's a French thing. It's this minister, Thévenoud, who was minister under Hollande, and he stayed minister for 9 days. So beating Liz Truss by a good margin. So why did he resign? He did not file his taxes in 2012, and he was late every time. Okay, and so he publicly claimed he was suffering from administrative phobia. What I find excellent with his story is that he actually, within few days from resigning, he filed at the patent agency to have his brand registered, which is phobie administrative. So he has this brand, and he can put it on mugs or on whatever. I don't know what he's doing with it, but so he didn't have phobia to fill in the paperwork for the INPI. Anyway, that's a private rant. Okay, so let me quickly summarize the papers in tables. And again, I won't cover all of them, but this is your baseline. Okay, so we have a baseline level. So I'm organizing it between the debt level, 0 to 100, 120, 200, 200 to 300. This is in euros, okay, and 300 to 400. So we have enforcement after 200. Below and early is the December, late is February. So the baseline rate of payment is 60. With enforcement, you increase by 7% or 9%, but it's in between with enforcement. And when enforcement is going to kick in, you reach plus 17%. Okay. So when you add the letter, what do you do? So a very elaborate color code, but I'll go briefly on it. You have the blue effect. It's a very, very strong effect of the simple letter, which is pretty much equivalent. So it's the blue one. It's equivalent to the enforcement in the baseline. So plus 7 or plus 9. The effect is only present in the absence of enforcement. So I would interpret it as it's a substitute for enforcement, not a complement. I wouldn't emphasize the stakes issue. It's really how it interacts with enforcement. But you should also emphasize it's still a smaller effect in the later period. So it's still 7 only compared to 17. Okay, and then all the rest. So out of the to preserve the time. So when you add social comparison, and again, let me insist on the message. The message is just here is a reminder that you have to pay your tax. So it's a no message. So when you add social comparison, I think you should compare the norm, the letter with the social comparison, to the simple letter, because it's just adding to the simple letter a norm, and the extra effect is basically negligible. Okay, and pretty much disappears in the long run. So and adding enforcement letter, I already talked about it. So let me really insist on how I think you should change the focus. The main message of the paper should be a simple non-informative message can have an effect equivalent to a mild enforcement. When I say mild, it's because it's before the enforcement really kicks in. Okay, and it's a substitute, not a complement to enforcement, and it shed lights on all the literature, the rest of the literature with messages. It's sort of the benchmark. It's a benchmark that if you just send a letter, you'll have this effect. And so all the other results should be compared to that benchmark. But then you need to tell us why it's working. And that's where even if it's hypothesis, you need to structure something. So why is it working? Is it salience? Is it just an observation effect? You know, these experiments where you put pair of eyes in the experiment and apparently makes people give more. So is it the feeling of being more observed? You need to say a bit more. You can't just leave it to that. And so I think this should be the main message. And then all the rest is a sideshow. So the social comparison message is just to back up your point. The enforcement information is just shedding light on the different questions. And then the interaction between the two that you have at the end, between social comparison and the letter and enforcement. Honestly, I don't know what to make of it, so it's hard to put in. So I would just put it as a sideshow. So really say my message is just a simple letter is framing this whole literature on nudges and putting it in a different perspective. Anyway, that's my take, and I'll close on that. And thank again the organizers for that.
Thank you, Emmerich. So let's go to the questions. Edouard, Charles.
Yeah, Edouard Charles, European University Institute. Very naive question from someone outside this literature. What is very effective in this experiment, as I understand, is the pure nudging effect, because when there is a real threat, the additional effect is not so strong. But this applies to people who are responsible for relatively small delinquencies. Maybe, you know, they've had in the past, and then we're throwing at them this experiment where they receive a letter. Maybe they, you know, they think the system has changed, the sanction system has changed. They'll, you know, they make decisions under uncertainty, and, you know, they comply more than they would otherwise. How do we know that, you know, if we were to repeat to send letters over and over again over the years, they would not learn that this is inconsequential, and therefore that it would change their behavior. So I guess it's a question, you know, about the external validity of the experiment.
Roberto?
So this whole discussion about the blank message and also the non-compliance actually made me think about something related. I will get in touch about that. There's a nice paper by some American authors looking at the failure to show up in courts. Okay, so there are millions of Americans that don't show up in courts, and so they get arrest warrants for petty crimes or misdemeanors. And so there is in this literature, there's a science paper where basically that shows that a simple SMS, so, oh, you should show up, it's super effective. And what is interesting is that it should be 100% effective because, you know, you know that if you don't show up in court, there is a warrant, and indeed the effect that they find is about 13%. So of increase in show ups, so which is not very far from your 7%. So really, the nice thing of that paper is that they dig more into that, and they find that so those that don't show up are really marginal people. In the sense there are many, but they are the margin of the society and so on. So it seems to go in this direction. Probably some link with that would be helpful.
Isabelle?
Yeah, Isabelle Méjean from Sciences Po. It's more out of curiosity, but I was wondering whether in the future it might be possible to link this data over time so that you can see whether the people repeat their delays, like they are a bit systematically late, which I would expect from somebody who has an administrative phobia. Like, and this might be important regarding Edward's question as well.
Yes. Can you say your name?
Nicola Tamberi from University of Sussex. I had the same question about the arrival of the news, and so whether you would learn with that and in the future not comply anymore with the letter. And the second question is, as the discussant says, Sweden, maybe everybody expects Sweden to be very tax compliant. So how would this apply to other countries? Is there any way you could try to see whether there's some heterogeneity in the effects maybe across different regions, if there are differences across rates of tax compliance in different areas of Sweden? So then perhaps do some extrapolation to, I don't know, you go in certain European countries where tax compliance is lower.
Okay. Zofia Barani.
Okay, so you already said my name. I don't have to say it. Good. So I just wanted to ask, is it possible that these people just forgot? So when they paid their taxes, maybe they didn't have money and then they forgot about it, and getting the letter just reminds them? Because that would also explain why you don't see any later ones, because either they pay it immediately or they forgot again. And then, you know, by February, it's not that they will remember later.
I was also wondering about the if you repeat the same nudge, which is inconsequential over years, do we know whether this will, the effect could disappear? Because I mean, after a while, you don't take care anymore of these type of things. Do we have any evidence on that? Okay, I think if there is no more question, you can answer.
Okay, thank you very much for the primarily our two discussants, and I hope that we can get your slides afterwards so we can go through the comments, because I think they were really, really useful. And also thank you for all the other questions here. So I will briefly try to answer some of the questions, and then I'll see if my co-authors have anything to say about some of the others? And so we'll see. Perhaps we don't have all good answers to all of the questions and comments, but at least to some of them. So the first one, why? I mean, the reason why these people have not paid, and so why didn't they pay the first time? So, and I think that, I mean, there could be several reasons for that. So one thing could be that you raised now that they simply forgot, because at least during these years, I think that they got a letter in, I think it was in August from the tax agency that you have to pay in November. And that's quite a long time period. So that's, yeah, of course I will do that. And so, of course, people could have forgotten. But when people have forgotten, I mean, when they then get this letter in December, they should get a reminder, even though it is like you showed this, that it's not a very easy to read letter that comes, but it should be, I mean, a reminder. So, but for some reason, some people don't pay anyway. And of course, it could be, like it was pointed out, that these are very small amounts. So of course, a fraction of these taxpayers are probably poor people who cannot pay, and they cannot pay if they just get the standard reminder, if they get a nudge, if they get a threat of enforcement, they won't pay anyway, simply because they can't. And also for why the threat of enforcement, why don't we see 100% actually paying there? And it was also, one of you pointed out that, I mean, what if they already have lots of debt at the enforcement agency? And unfortunately, we don't know that. What we know, and what we have deleted those who have a tax debt with the enforcement agency. So those who didn't pay their taxes last year and still haven't paid, so they haven't got payment defaults and so on. Those we can get rid of in our data, but we don't know if they are with the enforcement agency for other reasons. So, because I think that is also one explanation, that, okay, I have already this payment default. I have already lots of debt at the enforcement agency. If also the tax agency transfers 2,000 Swedish kronor, I don't care. So, but unfortunately, we cannot control for that. And then also this, that we focus on very, very small amounts. And of course, I mean, since this is the legal threshold, and that is something that we were also actually thinking of, perhaps that is also a policy conclusion, that perhaps this threshold, 2,000 Swedish kronor, about 200 euros, that's too low. I mean, we've actually tried to do some kind of a cost-benefit analysis, but we didn't dare to do something because we didn't think that it would be that good, because we would also have to guess about very many things. But of course, I mean, both sending these people to the enforcement agency, of course, that is probably more expensive. I mean, that itself is a negative effect. And then, I mean, when it comes to Giacomo, you mentioned with the postage and things like that, and we actually nowadays, most of these letters are actually electronic, and that is also something that could affect this. And we've actually looked into that, and we saw that, I mean, doing this electronically has a smaller effect than if we send those with the pure nudge. And that could also be one of those, I mean, the effect of doing this in the longer run that, okay, if people just get all this electronically and they, I mean, it's another PDF filer. So, I mean, perhaps that would, in the longer run, we would not see any effects of these nudges anymore. I also think it was very good suggestions to, I mean, how we should organize this and what we should actually focus on, that these pure nudges, that is actually a substitute for the threat of enforcement. And also that the reason why we just look at February is that we want to have a short period of time, and then, I mean, we know that those who were actually sent to the enforcement agency, they should make their payment in January. So if we include February, but then of course, I mean, we could of course, I don't know if we have data for that long, but of course, in principle, people could pay later on, but I mean, they're supposed to pay to the enforcement agency. And so, yeah, there were lots of other things, but I think that these were the.
Can I just add a note?
Yes.
On the February thing. Hi, I'm Susanna. I work for the Swedish tax agency, and the enforcement agency, they start to work after February. So after that, we cannot really just look at the nudge letter and see the effects of that, because then the enforcement agency tried to work on these people to get their payments. And also what we saw, I think, in when we did the first bit of this study, we saw that people tend to pay as soon as they receive a letter from the enforcement agency, they tend to pay. So it seems maybe they have the money, but they don't understand the tax agency letter. But once they receive a letter from the enforcement agency, it's much more salient. So then they pay. So it seemed that maybe it wasn't that much about the money issue, more of like who is sending the letter to them. Thanks.
Okay, thank you very much. So we are toward the end. So I want to thank everybody, especially Mariolina, who organized everything very smoothly, very efficiently. Also the Ministry of Finance for the hospitality, very nice hospitality. So thank you also for organizing all the online stuff and the sound. Okay, thank you very much. Yeah. Managing editors, also panelists who are going to leave us, who have worked very hardly for 2 years. So thank you very much to all of you. It was very, very nice to have you on board. And I hope we will have the opportunity to interact again in the very near future. And so thank you. Also managing editors, a fantastic job. Thanks to all of you. So and all panelists. So thank you. Okay. And we look forward for those who will be there to meet again in Stockholm in April. So see you there. Bye-bye.